The story begins in a world that moved more slowly than the one you know today. A world where coins were heavy in the hand and wealth carried the metallic scent of the earth. People traveled through markets lined with wooden stalls, exchanging goods by weight, touch, and familiarity. In those early days, money felt solid and finite. A bag of silver could only be divided so many times. And each piece carried the imprint of a ruler whose authority gave it meaning. Yet even then, beneath the clinking of metal and the murmur of trade, a quieter idea had already begun to take shape. It whispered that value did not need to be tied entirely to the substance of coins. It suggested that trust, when shared widely enough, might hold more weight than metal. This idea surfaced gently, almost without notice, in the simple act of leaving valuables with someone reliable. Travelers who feared thieves would entrust their gold to merchants or keepers, receiving a handwritten note promising its safe return. Over time, these notes began to travel farther than the gold itself. People discovered that the promise could move more easily than the weight it represented. They could buy goods by handing over the note instead of the gold. What began as an exchange of metal became an exchange of trust, and trust proved remarkably portable. This shift marked the earliest step toward a world where money could exist as an idea, independent of physical form. As villages grew into towns and trade routes stretched across continents, the need for a safer, more organized system became clear. Goldsmiths, who possessed secure vaults for their craft, began storing coins and precious metals on behalf of others. In return, they issued receipts that declared how much had been deposited. These receipts became early forms of money, circulating through communities as people grew confident that they could redeem them at any time. The gold remained unmoving in the vault, while the receipts traveled freely, passing between hands in markets, inns, and fairs. The system grew not through force, but through convenience. People preferred the ease of paper over the burden of metal, and confidence deepened with every successful exchange. This growing reliance on paper set the stage for the birth of banking. Goldsmiths noticed that most depositors rarely claimed all their gold at once. The metal sat untouched for long stretches of time, resting in the quiet darkness of the vault. The goldsmiths realized that they could lend some of this idle gold to borrowers who needed funds, charging interest in return. The deposits remained secure, the borrowers gained resources, and the goldsmiths earned profit. This simple discovery that value could be created by lending what remained unused became a foundational insight. Over time, goldsmiths evolved into bankers, and vaults transformed into institutions where money did far more than rest. As banks formalized their role, the idea of money creation emerged naturally from the way lending worked. Whenever a bank issued a loan, it did not hand out physical gold. It wrote numbers in a ledger, expanding the total amount of money that existed within the system. These numbers represented claims on future payment rather than the transfer of existing coins. When borrowers spent the money, it entered the economy as something newly created, flowing between merchants and workers who accepted it because they trusted the system that produced it. The act of writing in a ledger allowed banks to create money that had not existed the moment before. This transformation unfolded quietly, becoming one of the most powerful forces in economic life. This early form of money creation did not spread through grand announcements. It grew through repetition and familiarity. People realized that the money created by banks behaved exactly like traditional currency. They could buy food, pay workers, and settle obligations with it. The trust they placed in gold extended naturally to the receipts and ledger entries that banks produced. The more people used this system, the more natural it felt. Money no longer needed to be mined from the earth. It could be generated through agreements, expectations, and shared confidence. The world stood on the edge of a profound transformation, yet the change felt almost effortless, as though the shift from metal to paper had been waiting to happen all along. As the system matured, individuals began to see banks not merely as storage for their wealth, but as partners in their ambitions. Farmers borrowed to buy land, merchants borrowed to expand routes, and artisans borrowed to purchase tools. Each loan represented potential, a moment when the future extended beyond immediate means. Banks became bridges between present limitations and imagined possibilities. They offered access to resources that individuals did not yet have, but expected to earn. Money, once bound by the weight of metal, became a fluid concept tied to time, trust, and the promise of repayment. This new relationship between people and banks created a rhythm in the economy. Deposits flowed in, loans flowed out, and each transaction reinforced the belief that banks functioned as the heartbeat of financial life. The system thrived on predictability. Most depositors withdrew only small amounts at any given time, allowing banks to lend confidently. Borrowers repaid loans gradually, enabling banks to extend new credit. This cycle became a quiet machinery that sustained families, businesses, and entire communities. Although few people fully understood how the machinery operated, they sensed that it worked, and that was enough for confidence to grow. Trust, in this context, became a form of collective power. It allowed banks to facilitate transactions far larger than the gold in their vaults. It allowed societies to expand industries, build infrastructure, and support growing populations. The belief that banks would honor their commitments became as valuable as the gold itself. In time, people no longer questioned whether the bank held enough metal to match every claim. They accepted that the system functioned through balance rather than direct equivalence. The idea that money could exist in multiple places at once, both in the vault and in the ledgers, became a central truth of everyday life. As this truth took hold, banks began to operate more like arteries in an economic body, channeling funds where they were needed and drawing strength from the continuous movement of deposits and loans. Money, once slow and physical, became agile, capable of circulating rapidly through towns and across borders. Businesses could operate on credit, governments could fund projects, and families could weather unexpected hardships. The circulation of bank-created money wove communities together in new patterns, connecting distant regions through flows of credit and payment. The world became more interdependent, its movements guided by the invisible currents of money that banks brought into being. This interdependence deepened as banks grew in number and sophistication. Each institution maintained records of deposits, loans, and transactions, relying on bookkeeping as much as on physical reserves. The accuracy of ledgers became a cornerstone of economic life. Bank clerks copied entries carefully, their handwriting shaping the flow of money with every stroke of ink. These records represented the memory of the economy, preserving the details that allowed trade to function smoothly. People learned to trust the precision of these records, knowing that the stability of the system depended on their integrity. Over time, the system evolved further as banks began to cooperate with one another. Clearinghouses emerged to settle debts between institutions, ensuring that payments could flow seamlessly across different regions. These cooperative structures strengthened the stability of banking, reducing the risk that any one institution could disrupt the system. Banking networks grew like interconnected branches, spreading across cities and countries, forming a web that supported commerce on an ever-expanding scale. This web allowed money to move more freely, reinforcing the idea that credit, not metal, formed the true backbone of economic life. The quiet revolution of money creation continued to develop as societies grew more complex. Banks introduced new services, checking accounts, promissory notes, and agreements that allowed payments to be made without physical exchange. These innovations reduced friction in commerce, making transactions faster and more convenient. Each advancement expanded the role of banks, weaving them more deeply into daily life. The boundaries between personal wealth and bank-issuing credit blurred, merging into a single system where value flowed through trust, records, and shared expectations. growing reliance on banks convinced societies to view them as custodians of stability. People depended on them to protect savings, to lend responsibly, and to support the functioning of markets. As banks, in turn, depended on the confidence of the public. The entire structure resembled a delicate yet enduring ecosystem where each participant reinforced the others. The strength of the system lay not in its metal reserves, but in the cooperative belief that money, once created, would be honored and accepted. This collective belief allowed economies to grow far larger than the sum of their physical resources. As the story reaches this quiet moment, the world stands at the threshold of a new understanding. Money has transformed from something tangible to something conceptual, shaped not by the minds that produce metal, but by the institutions that record agreements. The idea that banks create money from nothing becomes clearer, not as an illusion, but as a reflection of how trust and cooperation give life to value. What began with a goldsmith's vault and a handwritten receipt has grown into a vast architecture of credit that supports modern civilization. From here, the journey continues deeper into the mechanisms, psychology, and global structures that sustain this invisible creation, guiding you gently into the next part of the story. The transformation from physical currency to a system built on promises unfolded gradually, shaped by the needs of growing societies and the delicate convenience that paper offered over metal. In the early stages of this transition, people still felt the weight of coins in their pockets as a reassurance of value. Yet even as they carried silver and gold, they increasingly relied on handwritten notes, signatures, and the reputations of trusted individuals to facilitate exchanges. These new instruments did not clang like coins or shine like precious metal, but they carried something far more powerful, the collective belief that value could be represented through words, agreements, and symbols rather than by physical substance alone. This shift marked the beginning of a world where money would exist not as a physical object, but as an idea shaped by confidence and expectation. The earliest forms of these written promises began among merchants who needed ways to conduct business across long distances. A trader in one town might deliver goods to a supplier far away, receiving only a written acknowledgement in return. This acknowledgement served as a placeholder for payment, redeemable at a later date. Over time, these notes began to circulate among other merchants who trusted the original parties. The note itself became a form of money, detached from the goods that had set the exchange in motion. What mattered was not the physical object, but the belief that the note would be honored. This belief became the invisible thread tying communities together, allowing goods, services, and obligations to move with a flexibility that metal alone could not offer. As these practices spread, ledgers emerged as the true foundation of financial life. Each entry in a ledger captured a promise, a record of what one person owed another. Early bookkeepers played an essential role in maintaining these records, ensuring that the trust embodied in each entry aligned with the reality of transactions. Their work gave stability to a system built on intangible value. When someone purchased goods on credit, the ledger captured the moment as though it had been carved into stone. When someone repaid a loan, the ledger confirmed that a promise had been fulfilled. Through these systems of record, societies began to understand that money could exist as a relationship rather than as an object, shaped by trust rather than by metal. The power of these written promises grew as banks formalized their role. Banks became centers where ledgers were maintained with precision, where transactions were documented, and where credit could be extended based on the strength of a depositor's reputation. These institutions gave structure to the growing world of paper money. Instead of relying solely on personal trust between individuals, people began to trust the institution itself. A bank's involvement transformed a private agreement into something public and official, recognized not only by the individuals who participated, but by the entire community surrounding them. The introduction of checks further advanced this transition. A check allowed someone to instruct a bank to transfer money from their account to another person. The check itself held no value, yet it became a powerful instrument because it represented the authority of the bank to move funds. With checks, people no longer needed to carry coins or even paper notes. They could authorize a payment through writing alone, and the bank would adjust the ledger accordingly. The movement of money became an act of communication rather than an act of physical exchange. This new form of payment transformed commerce, making it faster, safer, and capable of taking place across increasing distances. As checks and ledgers became central to financial life, a profound insight emerged. The amount of money that existed in the system was no longer tied to the amount of metal stored in vaults. It depended, instead, on the relationships captured within the ledgers. When someone deposited money in a bank, the bank did not merely hold it. Deposit became the foundation for future loans. When someone borrowed money, the bank recorded the loan as an asset on its books and credited the borrower's account with newly created funds. These funds existed only in the ledger, yet they functioned exactly like money created through metal. They could be spent, saved, or transferred through checks. This system allowed money to expand far beyond its physical origins, shaped by needs, opportunities, and shared expectations. Fractional reserve banking emerged from this environment as a natural extension of lending practices. Banks realized that they did not need to hold all deposits as physical reserves. Most depositors withdrew only a small portion of their funds at any given time, allowing banks to lend out a majority of the deposits while keeping only a fraction available for withdrawals. This practice amplified money creation. Each loan became a deposit in another account, and that deposit became the basis for additional lending. Through repeated cycles of lending and depositing, the total supply of money grew far larger than the amount of physical currency that existed. This was not considered deceitful. It was understood as the mechanism through which credit expanded to meet the needs of a developing economy. This expansion of credit supported trade, agriculture, craftsmanship, and industry. A farmer could borrow 2 plant crops months before harvest. A merchant could acquire goods to sell long before receiving payment. An apprentice could purchase tools to begin a new trade. The ability to borrow against the future allowed societies to grow more dynamic, flexible, and forward-looking. Money creation became intertwined with possibility, shaping the destinies of individuals and communities alike. The invisible expansion of ledger entries supported the visible expansion of markets, towns, and industries. As this system matured, it became clear that trust remained its most essential component. Without trust, paper promises held no weight. Without trust, ledgers were nothing more than ink on parchment. It was trust that allowed people to accept a check, trust that allowed them to borrow, and trust that allowed them to believe that the bank would honor its commitments. This trust did not depend solely on the integrity of individuals. It depended on the stability of the banking institutions themselves. Banks became symbols of safety, pillars of the community whose reliability shaped the rhythm of economic life. Because banking relied so heavily on trust, the earliest signs of instability created anxiety. When people feared that a bank might fail, they rushed to withdraw their deposits. These withdrawals often exceeded the bank's available reserves, not because the bank lacked value, but because trust had fractured. Such events revealed the delicate nature of a system built on promises and ledgers. People learned that confidence could create money just as surely as fear could erase it. These experiences encouraged societies to seek stronger structures to support the system, prompting the eventual creation of central banks, regulatory frameworks, and cooperative agreements between institutions. Yet, during the period before these safeguards emerged, people lived in a world where banks operated as both stabilizers and catalysts. Their ability to create money through lending allowed economies to grow rapidly. Their dependence on trust made them vulnerable to shifts in sentiment. This fragile balance shaped the early understanding of money as something both powerful and precarious. People realized that money depended not only on material reserves or written promises, but on the collective confidence of everyone who participated in the economy. This realization became a quiet force guiding the evolution of banking systems across generations. As paper money and ledger-based credit grew more common, the physical currency underlying the system became increasingly symbolic. Coins and notes served as reminders of value, but most money existed as ink in ledgers, and, later, as numbers in books. This abstraction allowed economies to grow far larger than their physical resources. It enabled the construction of roads, ships, factories, and institutions through borrowed money that represented expectations of future productivity. Money creation became a tool for shaping the future rather than merely reflecting the present. The abstraction of money also influenced how people thought about wealth. Wealth was no longer limited to what someone possessed physically, extended to what someone could promise, negotiate, or plan. A person's reputation, reliability, and relationships became forms of value. A business's potential became as meaningful as its current holdings. The economy evolved from a system grounded in objects to a system grounded in trust, information, and expectation. The shift from physical to conceptual value marked a profound change in the nature of money. Yet, it unfolded so gradually that few people recognized how deeply it was reshaping the structure of society. As this part of the story ends, the world stands in a moment of quiet transformation, where paper and promises have become the lifeblood of trade. The shift away from physical money has taken root, setting the stage for fractional reserve banking. The rise of credit and the creation of money through the decisions of institutions rather than the minting of coins. The next stage of the journey explores how these changes solidified into the system that governs modern banking, guiding economies with invisible mechanisms that quietly shape the world. The evolution of banking into a system capable of creating money did not emerge through a single breakthrough or sudden discovery. Instead, it unfolded through a series of quiet realizations, each building upon the last, until banks found themselves performing a role that would have seemed extraordinary in earlier centuries. At the heart of this transformation lies the principle of fractional reserve banking, a mechanism so ordinary in practice, yet so powerful in its implications that it reshaped the very structure of economic life. To understand how this system took hold, it helps to move slowly through its origins, as though watching layers of meaning accumulate across generations. In the early days of formal banking, the notion of holding reserves seemed simple. A bank accepted deposits from customers, kept them safe, and returned them upon request. Yet banks quickly noticed that depositors treated their money much like a reservoir they rarely drained. People deposited coins, conducted some withdrawals, and left the rest untouched for long stretches of time. This predictable behavior allowed banks to lend portions of those deposits without jeopardizing their ability to meet daily withdrawals. The moment banks recognized this rhythm, they stepped into a new role, not merely protectors of wealth, but creators of credit. The act of lending did not require a bank to hand out the physical coins deposited by others. Instead, banks wrote new entries in their ledgers, marking down the amount loaned to the borrower and crediting their account. The borrower now possessed new funds, even though no additional physical money had entered the system. The bank still held the original deposits, and the borrower now held a new claim on money that did not exist before. This simple ledger entry expanded the total amount of money circulating within the economy. It became clear that loaning deposits did not transfer existing money, created new money. This was not an illusion or a trick. It reflected the fundamental truth that money could be created through agreements and expectations rather than through minting. As long as borrowers repaid their loans and depositors continued to trust the bank, the system worked smoothly. Money creation became inseparable from lending, and lending became inseparable from the economic growth it fueled. The process felt natural, intuitive, and aligned with the needs of communities expanding in size and ambition. Fractional reserve banking took shape from this interplay. Banks kept a fraction of deposits available for withdrawal and loaned the rest. If a bank held 100 units of currency and expected that no more than 10 units would be withdrawn at once, it could lend 90 units. The 90 units lent would soon be deposited into someone else's account, enabling another bank to lend a portion of them. Through this chain reaction, an initial deposit could multiply many times over, expanding the total supply of money far beyond the original amount. The process unfolded quietly, like ripples spreading across a still pond. The multiplication of money through lending allowed economies to grow in ways that would have been impossible under a purely metallic system. Industries could expand, cities could be built, and innovations could be financed through money that existed only in ledgers. Borrowers used this credit to hire workers, purchase tools, build structures, and create goods. As the borrowed funds flowed through the economy, they sustained livelihoods and fueled ambitions. It began as a theoretical expansion of numbers in a book, translated into real changes in the physical world. Banks became central pillars in the expanding economic landscape. Their decisions about lending influenced the pace of development. When banks offered credit freely, construction projects flourished, businesses grew, and communities prospered. When banks tightened lending, economic activity slowed, revealing the profound connection between credit and the rhythms of daily life. The power to expand or restrict credit placed banks in a position of quiet authority, shaping the direction of local and national economies through choices that did not feel dramatic but carried far-reaching consequences. As fractional reserve banking became the standard, societies began to understand that money existed in two forms: the physical currency that people could hold, and the far larger pool of money represented in bank accounts. The second form, though intangible, became the primary medium of exchange. People wrote checks, recorded transactions, and made payments without ever touching physical money. They trusted that the entries in their accounts had value because the system had proven reliable again and again. Confidence replaced metal as the anchor of monetary life. This shift in perspective reshaped how people understood wealth. Under a metallic system, wealth was tied directly to the amount of precious metal one owned. Under a system based on fractional reserves, wealth expanded through credit, through the ability to borrow, invest, and repay. A person with a strong reputation for repayment became as valuable as someone with a chest full of coins. A business with potential became worth more than its immediate resources. Communities began to measure prosperity in terms of opportunity rather than mere holdings. The abstraction of money also created new possibilities for cooperation. Because credit relied on trust, people learned to evaluate character, reliability, and long-term vision. Banks considered the health of communities, the reputation of families, and the stability of industries when deciding whom to lend to. This process strengthened relationships between banks and the people they served. Banks became more than storage facilities for wealth. They became partners, advisors, and facilitators of futures. Yet the power to create money came with responsibilities and vulnerabilities. Fractional reserve banking worked smoothly when confidence remained intact. But when trust faltered, even slightly, the system showed its fragility. If too many depositors attempted to withdraw their money at once, the bank could not meet the demand, even though its overall financial position might remain healthy. These events, known as bank runs, revealed that money created through lending was anchored not in gold, but in belief. When belief wavered, the abstraction of money became visible, and the system trembled. Bankers, merchants, and governments recognized the need for safeguards. They understood that the system relied on maintaining the delicate balance between reserves and loans. Banks began to hold more detailed records, adopt conservative lending practices, and cooperate with other institutions to prevent destabilizing flows of withdrawals. Over time, Clearinghouses and later central banks emerged to provide additional stability, ensuring that no single bank stood alone in moments of uncertainty. These developments reinforced the resilience of the fractional reserve system. Despite these vulnerabilities, the benefits of fractional reserve banking far outweighed the risks. It allowed societies to mobilize resources far beyond what they physically possessed. It enabled people to pursue education, open businesses, and build homes long before they accumulated the wealth to do so. It encouraged governments to undertake projects that improved cities, transportation, and public life. Credit, created through fractional reserves, served as a bridge between present limitations and future possibilities, shaping the world through its quiet presence. As time passed, the system became so deeply embedded in economic life that people rarely paused to consider its origins. They accepted checks, opened bank accounts, and took out loans without questioning how banks could create money through ledger entries. The system felt natural because it had grown alongside society. The ledger became as trusted as the coin, and the promise became as valuable as the metal it once replaced. The emergence of fractional reserve banking also reshaped the relationship between money and time. Money became something that could be borrowed from the future and repaid through future earnings. Stability transformed the structure of life decisions. Individuals could invest in education with the expectation of higher incomes ahead. Families could purchase homes long before they saved the full price. Entrepreneurs could launch ventures based on the anticipation of future profits. The present and future intertwined through the mechanism of credit, allowing dreams and ambitions to take form before the resources existed physically. As economies expanded through credit, the role of banks grew more intricate. Banks needed to evaluate risks carefully, maintain reserves prudently, and manage their ledgers with precision. Their decisions influenced inflation, interest rates, and the availability of credit. Kiva, without intending to, banks played an essential part in shaping national economic health. K. The creation of money through lending became a cornerstone of prosperity, a quiet force guiding the direction of societies. K. The story of fractional reserve banking, then, is not simply the story of how banks multiply money. It is the story of how societies learn to build on trust, how individuals learn to borrow from the future, and how communities learn to turn promises into bridges, connecting what is possible now to what could become possible later. It is the story of how money evolves from something tangible to something conceptual, guided not by the limits of metal, but by the expansiveness of belief. As this gentle chapter draws to its close, the world stands fully immersed in the system that fractional reserve banking created. A world where money springs forth from agreements, where ledgers carry as much weight as coins, and where credit forms the quiet engine behind nearly every modern achievement. The next part of the story will drift deeper into the mechanisms inside a bank, exploring how each deposit, loan, ledger entry contributes to the continuous creation of money that shapes the modern economy. Inside a modern bank, the mechanisms of money creation unfold with a kind of quiet precision that feels almost invisible from the outside. People walk through the doors with routine intentions, depositing paychecks, withdrawing cash, transferring funds, and aware that each interaction plays a part in a much larger process. The machinery that supports this process does not clang or hum. It moves softly through digital entries, internal calculations, and the continuous balancing of accounts. To understand how banks create money from nothing, it helps to slow down and observe these internal movements as though watching the gentle workings of a clock, each gear turning not with force but with harmony. The journey begins with something as simple as a deposit. When a customer places money into their account, the bank does not store that money in a separate compartment. Instead, it records the amount as a liability and obligation the bank owes the depositor. The deposit becomes part of a larger pool of funds that the bank manages collectively. From the bank's perspective, deposits are promises they must honor, not physical objects they must guard individually. These promises appear as numbers in the bank's system, forming the foundation upon which all further activity rests. The bank, however, does not allow these deposits to sit unused. It observes patterns in customer behavior, noting that withdrawals tend to follow predictable rhythms. People withdraw in small amounts relative to the total funds on hand. This consistency allows the bank to set aside only a fraction of deposits as reserves, keeping the rest available for lending. These reserves act like a cushion, a buffer that protects against unexpected surges in withdrawals. The remaining portion becomes part of the bank's lending capacity, the raw material from which new money is created. When the bank approves a loan, it does not hand out money taken directly from someone else's deposit. Instead, it creates a new entry in the borrower's account, crediting them with funds that did not exist moments before. This newly created money is indistinguishable from any other money in the system. The borrower can spend it, transfer it, or withdraw it. The act of lending is therefore also the act of creating. With each loan, the bank expands the total money supply through nothing more than a ledger entry backed by trust and confidence. From the borrower's perspective, the funds feel real and immediate. A person who receives a loan to buy a home sees numbers appear in their account that translate into concrete possibilities. They pay the seller, who deposits the funds into their own account. The money created by the loan now circulates freely through the economy. The home changes ownership, workers receive wages, materials are purchased, and services are paid for. The new money ripples outward, touching countless interactions, each one reinforcing the idea that money is fluid rather than fixed. As the loan begins its life in the economy, the bank records it as an asset. The borrower owes the bank the amount of the loan, plus interest. This loan represents a future inflow of money for the bank, anchoring the newly created funds in an expectation of repayment. The relationship between the loan and the deposit becomes a quiet tension between present creation and future fulfillment. The money created today will return to the bank gradually in pieces over months or years. Each repayment reduces the outstanding loan and, in turn, reduces the total amount of money circulating in the system. Through this cycle, money is not only created, but also destroyed. This continuous cycle of creation and destruction forms the heartbeat of the banking system. When loans are abundant, the money supply expands, fueling growth and activity. When loans contract, the money supply tightens, slowing economic movement. The bank's decisions about lending, how much to lend, to whom, and at what rate shape the rhythm of the economy. These decisions rely on careful analysis of risk, market conditions, and customer needs. Even though the mechanisms are quiet, the impact reaches every corner of society. Inside a bank, this process unfolds through a mixture of human judgment and structured procedures. Loan officers evaluate applications, balancing optimism about opportunity with caution about risk. They examine income, collateral, credit history, and the purpose of the loan. Their decisions reflect not only the interests of the bank, but also the health of the community. A well-considered loan can enable a business to thrive, a student to pursue education, or a family to secure a home. Each approval becomes a quiet affirmation that someone's future holds potential worth investing in. Once loans are granted, the bank must ensure that its reserves remain sufficient. Reserve management occurs behind the scenes, where analysts monitor daily flows of deposits and withdrawals. They use historical data and predictive models to estimate how much money should remain on hand. These calculations require a delicate balance. Holding too much in reserves limits the bank's ability to lend and create money. Holding too little exposes the bank to risk. The stability of the entire system relies on these careful judgments made silently within the institution. As the bank manages reserves and lends money, it also participates in a broader network of transactions with other banks. When a customer writes a check or makes an electronic payment to someone whose account is held at another institution, The banks settle the difference between them. These settlements occur through a system of interbank payments that ensures the smooth flow of funds. If Bank A transfers money to Bank B on behalf of a customer, the reserves of Bank A decrease while the reserves of Bank B increase. This constant movement of reserves ties banks together in a web of interconnected obligations. Through this interbank network, the money created by one bank becomes part of the reserves of another. A loan issued by one institution may eventually support lending activities at another. The system becomes a living organism, each part influencing the others, each movement shaping the whole. This interconnectedness amplifies the effects of money creation, allowing funds to circulate widely and support economic activity across regions. As money flows through accounts and between banks, the ledger becomes the central medium through which value is recorded. Modern ledgers are digital, stored on servers and updated in real time. Yet the principle remains the same as it was in the days of handwritten books. The ledger is the memory of the system. It records who owes what, who owns what, and how money travels through the economy. This memory gives structure to the abstract nature of money creation, grounding it in a series of relationships that can be traced and verified. The digital nature of modern banking has added new layers of speed and efficiency. Deposits appear instantly, transfers occur within seconds, and loans are credited with the press of a button. This acceleration does not change the underlying process of creation, but it enhances the fluidity with which money moves. It also extends the reach of banking, allowing individuals and businesses to interact with the financial system through phones, computers, and online services. The abstraction of money becomes even more pronounced as physical cash plays a diminishing role in daily life. Despite this abstraction, the core of money creation remains deeply grounded in human behavior. Trust remains essential. Borrowers must trust that banks will honor their commitments. Banks must trust that borrowers will repay. People must trust that the numbers in their accounts represent real value. This mutual trust supports a system that multiplies money far beyond the physical currency that exists. When trust is strong, the system expands smoothly. When trust weakens, the system contracts, sometimes abruptly. Banks are acutely aware of this dependence on trust. Their public image, customer service, and internal procedures all aim to reinforce reliability. The architecture of bank buildings, often solid and imposing, reflects this desire to project stability. The language of banking words like secure, guaranteed, insured, further supports the atmosphere of confidence. This atmosphere is not decorative, it is foundational. Without it, the mechanism of money creation would falter. Within this environment, credit becomes more than a financial tool. It becomes a social force that shapes the contours of life. People make decisions based on their ability to access credit. They choose careers, buy homes, start families, and pursue education with the expectation that borrowed money will support their plans. Businesses rely on credit to expand operations, hire workers, and innovate. Governments use credit to build infrastructure, fund services, and respond to crises. The money created by banks becomes the quiet pulse behind these life-shaping choices. As the events inside a bank unfold through written entries and digital movements, the outside world continues to rely on the invisible structure they create. People rarely pause to consider how a loan becomes money or how deposits support lending. It's present. They simply experience the benefits of a system that multiplies value through cooperative belief. This hidden architecture supports the buildings they live in, the jobs they work, the goods they purchase, and the services they depend on. The quiet movements of money creation touch every aspect of modern existence. As this part of the story settles, the understanding grows that the mechanisms inside a bank are not mysterious tricks, but carefully balanced processes, grounded in trust, behavior, and collective cooperation. They expand the economy by creating money through lending, guided by the steady rhythm of deposits and withdrawals. The next part of the journey explores how trust itself becomes the backbone of this system, shaping not only financial stability, but the psychological and emotional landscape of modern society. Trust becomes the quiet foundation beneath every part of modern banking, shaping not only the mechanics of money creation, but the emotional landscape through which people move in their daily lives. Without trust, the system would collapse instantly, because money, especially money created from credit, exists only through shared belief. When a person accepts a digital balance as proof of wealth or hands a check to pay for goods, that person relies on a vast network of institutions, agreements, and customs working together seamlessly. This reliance is not conscious in every moment, but it forms a gentle certainty that allows life to unfold with confidence rather than fear. Understanding how trust supports the system reveals why money created from nothing feels real, usable, and dependable. Trust enters the world of banking long before a person ever makes a deposit. As a child observes adults using money, the child develops a sense that banks are secure places where value is kept safe. This early perception grows into an instinctive belief that numbers stored in accounts carry genuine weight. By the time individuals open their first bank accounts, they already consider banks to be pillars of security. They rarely question whether the bank holds enough physical currency to cover all deposits. The public's trust does not depend on seeing gold or cash. It depends on a cultural understanding that banks operate consistently and responsibly. This cultural trust is reinforced by the rituals of banking. When someone enters a branch, the environment is designed to convey reliability. The sturdy counters, professional staff, and orderly queues create an atmosphere of calm. Each interaction follows familiar routines: signing forms, presenting identification, checking balances. These routines provide emotional reassurance, confirming that the system is predictable and structured. Even as banking shifts toward digital platforms, the interfaces maintain this sense of order. Clear layouts, confirmation screens, and transaction histories replicate the feelings once generated by physical spaces. Trust travels through experience as much as through information. Beyond the individual experience, trust relies on the collective behavior of millions of people who use the banking system daily. Every time someone deposits a paycheck or makes a purchase with a card, they participate in reinforcing the system's stability. The regularity of these transactions sends a silent message: the system works. Widespread participation becomes a form of self-sustaining trust. People trust banks because others trust them as well. Okay? The collective belief becomes stronger than any single individual's doubt. Okay? Through this shared confidence, money created through lending acquires a sense of solidity, even though it consists primarily of numbers in digital ledgers. Trust also arises from the consistency of long-term experiences. For most people, banks reliably honor withdrawals, transfer funds correctly, and safeguard deposits over many years. This consistency allows trust to grow gradually, becoming part of the background of life. Even during moments of uncertainty, people often continue trusting their banks because the memories of stability outweigh the fear of instability. This long-term reliability forms the psychological bedrock upon which credit systems depend. The belief that money in a bank will be available tomorrow shapes how people save, spend, and plan. Within this environment of consistent trust, banks gain the ability to create money through lending. When a bank extends credit, it does so knowing that the borrower will likely repay, and the public will continue using bank-issued money without question. The borrower trusts that the bank will maintain their account accurately. The bank trusts that the borrower will honor their obligations. Society trusts that the bank and borrower will fulfill their roles. This chain of trust links individuals, institutions, and communities into a coherent system where credit can flourish. Money created from nothing becomes usable because trust fills the space where physical backing once existed. Trust also shapes interest rates, which serve as signals about the cost of borrowing and the value of saving. When people trust that banks are stable, They accept lower interest rates on deposits. They understand that the safety of their funds compensates for modest returns. Conversely, interest rates on loans reflect a bank's trust in the borrower. A borrower who demonstrates reliability and stability receives more favorable terms. In this way, trust becomes a currency of its own, influencing financial relationships in determining how money flows between participants. At a deeper level, trust is emotional. It provides a sense of calm, allowing individuals to navigate complex financial systems without constant worry. This calmness supports long-term planning, saving for retirement, purchasing homes, investing in education. People feel secure enough to commit to obligations that stretch across decades. This emotional stability allows economies to grow steadily as individuals and businesses make choices grounded in confidence rather than fear. Even when the system experiences disturbances, the underlying trust prevents widespread panic, helping the economy recover more quickly. The emotional dimension of trust extends to communities as well. When banks function well, communities feel supported. People can access mortgages, businesses can obtain funding, and neighborhoods can grow. Schools, public services, and infrastructure projects benefit indirectly from the credit created by banks. Trust becomes a shared emotional resource, easing the anxiety of uncertainty. Communities that trust their banks exhibit higher levels of cooperation and investment, creating positive cycles of development. However, trust is delicate. Just as it grows through consistent reliability, it can erode through mismanagement, rumor, or unexpected shocks. A bank run, for example, is not caused by a shortage of physical currency, but by a shortage of trust. People rush to withdraw funds because they fear others will do the same. The fear creates the very problem they hoped to avoid. This dynamic demonstrates that trust is not merely a psychological convenience, but a structural necessity. Without trust, the machinery of fractional reserve banking cannot function. This vulnerability encourages banks to nurture trust with great care. They adopt clear communication practices, provide customer protections, and ensure transparency in their operations. They emphasize their adherence to regulations, their insurance programs, and their long histories of stability. These efforts create an environment where people feel confident even without fully understanding the complexities of banking. The quiet architecture of trust supports the broader architecture of money creation, allowing credit to expand smoothly across the economy. Trust also influences how people interact with money created through digital systems. When someone checks an online balance, they trust that the number represents real value. When they send a payment electronically, they trust that the transaction will be processed accurately. Digital banking requires an even deeper level of trust than physical banking because there is no tangible currency exchanged. The experience depends entirely on the reliability of systems, networks, and institutions. People believe in the integrity of digital transactions because the technology consistently performs its role. This belief allows the abstraction of money to deepen, preparing society for future innovations in finance. The reliance on trust becomes even more significant during moments of crisis. When economies face uncertainty, governments, central banks, and financial institutions work to restore confidence. They provide guarantees, stabilize markets, and communicate clearly with the public. These actions aim to rebuild trust because trust is what allows credit to flow again. The recovery of an economy often depends less on the availability of physical resources and more on the restoration of belief. When people regain trust, they begin borrowing, spending, and investing once more, allowing the system to revive. As trust permeates the banking system, it creates a subtle shift in the way people perceive money. Money becomes less about what it is and more about what it represents. It represents confidence, continuity, and the expectation that others will honor their commitments. This collective understanding allows money created through loans to feel as real as coins once felt. The intangible becomes tangible through shared belief, and the abstraction becomes practical through widespread acceptance. Trust shapes not only the way people view money, but the way they view the future. Individuals make plans knowing that banks will support them. Businesses strategize with the expectation that credit will remain available. Governments budget with the assumption that financial systems will continue functioning. Trust becomes the invisible substance that binds plans, hopes, and actions into a coherent narrative. Without it, life would feel unsteady. With it, people move forward with assurance. The importance of trust also extends to the relationships between banks themselves. Banks trust that other institutions will settle transactions accurately, honor payments, and maintain their own stability. This interbank trust forms the backbone of the entire financial system. When banks work together smoothly, the flow of money remains uninterrupted. When trust fractures, even temporarily, the entire network feels the strain. This interconnected trust makes the system resilient, yet dependent on the continued reliability of every participant. As this part of the story draws to a calm close, trust reveals itself as the silent engine behind money created from nothing. It shapes the way people perceive value, interact with institutions, and plan for the future. It provides stability where physical backing once existed, allowing credit to replace metal as the foundation of money. In the next part of the narrative, the story moves toward the rise of central banks, exploring how these institutions emerged as guardians of trust, stabilizers of the financial system, and guides for the expanding power of money creation. Central banks emerged slowly, almost cautiously, as societies recognized that the expanding world of credit needed a guiding presence and institution that could watch over the system, steady it during moments of strain, and preserve the trust upon which everything depended. Their arrival was not the result of dramatic upheaval or sudden invention. It was the product of centuries of quiet observations, during which people noticed that the expanding system of fractional reserve banking carried both extraordinary possibilities and subtle vulnerabilities. As money creation grew more abstract, as ledgers replaced metal and credit replaced cash, the world needed a new kind of steward, one capable of maintaining balance across the entire financial landscape rather than within a single institution. The earliest precursors to central banks emerged in places where governments and banking institutions intersected. These organizations began as financial agents for the state, responsible for managing national debts, issuing currency, and facilitating large transactions. Their role grew gradually as societies expanded and economies became more interdependent. As merchants, banks, and governments collaborated in increasingly complex financial webs, they required a central authority to coordinate these activities. This coordination helped reduce uncertainty, strengthen trust, and ensure that the system of credit could continue to grow without collapsing under the weight of its own intricacies. One of the earliest and most influential central banks, the Bank of England, did not begin as the authority it would later become. It started as a private institution formed to lend money to the government. Over time, as the need for organized monetary management increased, the bank assumed responsibilities beyond lending. It issued banknotes, regulated the supply of currency, and acted as a stabilizing presence during financial disruptions. Other nations observed these developments and created their own central banks, adapting the model to suit their specific needs. The concept of a central banking authority slowly became a cornerstone of modern economies. Central banks evolved to fulfill multiple roles, each addressing a particular challenge within the financial system. One of their most essential functions was acting as the lender of last resort. Keen, in a system where banks operated with fractional reserves, the potential for panic always lingered. If a bank faced sudden withdrawals, even if it remained fundamentally healthy, it could run out of liquidity. Without outside support, the bank might fail, not because its assets were insufficient, but because trust dissolved too quickly. Central banks stepped into this vulnerability by providing emergency loans to institutions facing temporary liquidity shortages. This role prevented isolated fears from spreading into systemic crises. The ability of central banks to provide stability extended beyond emergency lending. They also became guardians of the payment system. As banks conducted transactions with one another, central banks acted as clearing agents, ensuring that funds moved accurately and efficiently across the financial network. This oversight strengthened the interconnected system of banking, reducing the risk of errors and delays that could erode trust. By guaranteeing that transactions settled reliably, central banks reinforced the integrity of the financial system as a whole. Another essential role of central banks emerged through their authority to regulate the supply of money. Because commercial banks created money through lending, the total amount of money in an economy could expand rapidly during periods of optimism or contract sharply during downturns. These fluctuations could create instability, affecting prices, wages, and employment. Central banks addressed this challenge by influencing interest rates, one of the most powerful tools for guiding economic activity. When central banks raised interest rates, borrowing became more expensive, slowing the expansion of credit. When they lowered interest rates, borrowing became easier, encouraging growth. Through this mechanism, central banks shaped the rhythm of the economy, smoothing out fluctuations and supporting long-term stability. The control of interest rates also allowed central banks to influence inflation, a phenomenon that arises when money grows faster than the goods and services available to purchase. Inflation can erode purchasing power, destabilize savings, and create uncertainty in economic planning. By adjusting the cost of borrowing, central banks could regulate the pace at which money entered the economy. Their goal was not to eliminate inflation entirely, but to maintain it at a level that supported stable growth. In this way, central banks became guardians of value, ensuring that money preserved its purchasing power over time. Central banks also acted as supervisors of financial institutions. As the complexity of banking increased, societies recognized the need for oversight to ensure that banks operated responsibly. Central banks established regulations governing reserve requirements, lending practices, and risk management. These regulations protected depositors, maintained public confidence, and prevented excessive risk-taking that could threaten the system. By setting standards and monitoring compliance, central banks reinforced the soundness of the financial structure upon which credit creation relied. The creation of central banks marked a transition from decentralized trust to organized trust. Instead of relying solely on the reputation of individual banks, society placed its confidence in a central authority tasked with preserving stability across the entire financial system. This transition did not diminish the importance of commercial banks. Instead, it allowed them to operate more freely within a structure designed to support their activities. Central banks became the quiet overseers of the system, stepping in only when necessary, guiding gently rather than dictating forcefully. As economies grew more interconnected across national borders, central banks formed networks of cooperation to support global stability. They shared information, coordinated policies, and provided support to one another during international crises. This cooperation strengthened the resilience of the global financial system, creating a network of trust that extended across continents. Central banks recognized that no country existed in isolation. Money flowed between nations, investments crossed borders, and shocks in one region could ripple outward. Their collaborative efforts became essential in a world where economic systems were intertwined. Beyond their technical responsibilities, central banks influenced the psychology of economies. Statements, assessments, and policy decisions shaped expectations. When central banks signaled confidence in the economy, businesses and consumers felt reassured, encouraging spending and investment. When they warned of caution, people adjusted their behaviors accordingly. K's ability to shape sentiment became as important as any formal policy tool. It allowed central banks to guide economic activity through a blend of communication and action, reinforcing trust and preventing panic. The presence of central banks also influenced how societies viewed money itself. As central authorities issued currency, regulated banks, and maintain stability. The public grew increasingly comfortable with abstract forms of money. People accepted that numbers and accounts represented real value because central banks ensured that this value was consistent and secure. The shift from metal to paper to digital balances became natural within a framework supported by institutional reliability. Central banks became the symbolic anchors that gave intangible money a sense of permanence. The role of central banks expanded further with the introduction of deposit insurance programs in many countries. These programs guaranteed that depositors would be protected even if a bank failed. This guarantee reduced the fear that once triggered bank runs, reinforcing trust in the system. With deposit insurance, people no longer felt the need to rush to withdraw funds during uncertain moments. The safety net provided by central banks and government programs allowed the system to function with greater stability and confidence. As central banks continued to evolve, they became increasingly sophisticated in their understanding of economic dynamics. They used data, research, and economic models to anticipate trends and prevent crises. Their work extended to analyzing employment patterns, monitoring financial markets, and supporting government efforts during economic downturns. They became not only guardians of stability, but also architects of economic policy, influencing the direction of national economies with careful deliberation. This expansive role did not diminish the importance of local banks, but enhanced their ability to operate safely. Commercial banks could extend credit, knowing that central banks stood behind the system. Borrowers could take loans, knowing that the currency they used would retain value. Businesses could invest, governments could plan, and individuals could save, all within a structure supported by central bank oversight. As the story of central banking unfolds, it becomes clear that these institutions act as quiet custodians of trust, ensuring that the system of money creation remains stable and reliable. But they do not create money in the same way commercial banks do. Instead, they shape the environment in which money is created, guiding the system with a steady hand. Through their presence, they allow the delicate mechanism of credit creation to expand without losing its balance. As this part of the narrative concludes, the world now stands with a clearer understanding of how central banks anchor the financial system. Their steady influence supports the creation of money, guides the rhythm of economic life, and preserves the trust upon which everything depends. The next part of the journey explores how monetary policy emerged, shaping interest rates, liquidity, and the flow of credit with increasingly refined tools designed to support long-term stability. Monetary policy emerged as a natural extension of the responsibilities central banks had assumed over time, evolving into one of the most delicate and influential tools in the modern financial landscape. Its purpose was simple in concept, yet profound in effect: to guide the flow of credit, stabilize the economy, and ensure that money created largely through loans within commercial banks circulated in a way that supported long-term health rather than short-term turbulence. Monetary policy offered central banks a way to influence the rhythm of lending and borrowing, adjusting the tempo of economic life through quiet, carefully calibrated decisions. These decisions were not imposed abruptly. They were introduced gently, with the understanding that the slightest shift could ripple through markets, businesses, and households across an entire nation. Interest rates became the centerpiece of monetary policy. They formed the invisible lever through which central banks influenced borrowing, spending, and saving. When a central bank lowered interest rates, borrowing became more accessible. Businesses could take loans to expand operations. Households could finance homes more easily, and consumers felt encouraged to spend. As money flowed more freely, economic activity accelerated, often lifting employment, production, and investment. When a central bank raised interest rates, borrowing slowed. The cost of loans increased, prompting caution among businesses and households. This cooling effect tempered inflation and slowed the pace of growth. Through these subtle adjustments, central banks acted as conductors, guiding the sprawling orchestra of economic activity without ever touching most of the instruments themselves. The connection between interest rates and money creation reveals the quiet elegance of monetary policy. Because commercial banks create money through lending, central banks influence the supply of money, not by printing currency, but by adjusting the conditions under which banks lend. Lower interest rates invite banks to extend more credit, increasing the total amount of money circulating in the system. Higher interest rates encourage banks to lend more cautiously, constraining credit creation. Through these gentle pressures, central banks indirectly shape the expansion and contraction of money itself. Yet, interest rates alone cannot fully capture the complexity of monetary policy. Central banks also rely on tools designed to support the stability of the banking system. One such tool is the reserve requirement, the minimum percentage of deposits that commercial banks must keep on hand rather than lend. By adjusting reserve requirements, central banks can influence how much money banks are able to create. Lowering reserve requirements frees banks to extend more loans, expanding the money supply. Raising reserve requirements limits lending capacity, tightening the flow of credit. Although reserve requirements are rarely changed in modern practice, they remain a powerful symbol of the central bank's oversight. Open market operations provide another essential tool. Through these operations, central banks buy or sell government securities in financial markets. When a central bank purchases securities, it injects money into the banking system, increasing reserves and encouraging more lending. When it sells securities, it withdraws money from the system, reducing reserves and slowing the expansion of credit. These transactions occur quietly, often unnoticed by the general public. Yet they shape the availability of money across entire economies. The subtlety of open market operations reflects the central bank's desire to influence conditions without causing abrupt shifts. A more modern tool emerged with the introduction of quantitative easing, a process through which central banks purchase large quantities of financial assets to stimulate the economy during periods of severe downturn. Unlike traditional open market operations, which involve smaller and more routine transactions, quantitative easing represents a large-scale injection of money into the system. It aims to lower long-term interest rates, support financial markets, and encourage investment when traditional tools are insufficient. Despite its scale, quantitative easing still aligns with the central bank's gentle approach, introducing liquidity gradually rather than through sudden floodgates. The emergence of monetary policy transformed the role of central banks from passive guardians of stability into active participants, guiding economic direction. Their influence extended beyond the mechanics of banking into the broader dynamics of employment, investment, and growth. By adjusting interest rates and influencing liquidity, central banks shape the behavior of millions of individuals and institutions. Their decisions affected whether people felt confident enough to buy homes, whether businesses expanded or contracted, and whether governments could borrow affordably to fund public programs. This influence depended not only on direct tools, but also on perceptions. Central bank communication became a crucial part of monetary policy. Statements, forecasts, and public speeches shaped expectations about future economic conditions. If a central bank signaled that it intended to raise interest rates, markets often reacted immediately, adjusting lending, investment, and spending behaviors even before the rate change occurred. This phenomenon demonstrated the psychological dimension of monetary policy. Expectations became as powerful as actions, and central banks learned to communicate with precision, minimizing uncertainty while guiding sentiment. Monetary policy also required central banks to monitor a wide range of economic indicators. They observed inflation rates, employment figures, economic output, consumer spending, and global developments. They analyzed trends, considered risks, and debated the timing and magnitude of their decisions. The process resembled listening to the subtle fluctuations of a complex instrument, requiring sensitivity to both immediate signals and long-term patterns. Through this careful observation, central banks aimed to maintain balance in the system, preventing overheating during periods of rapid growth and supporting recovery during downturns. The dual mandate pursued by many central banks to promote stable prices and maximize employment illustrated the delicate balance they sought. Stable prices ensured that money retained its purchasing power, protecting savings and encouraging long-term planning. Maximum employment reflected the desire to support livelihoods and productive capacity within society. These goals required constant adjustment as economic conditions shifted in response to global events, technological changes, and consumer behavior. The central bank's role became one of continuous guidance rather than periodic intervention. Monetary policy also shaped the relationship between governments and financial institutions. While central banks operate independently in many countries, their decisions have profound implications for government budgets. Low interest rates make it easier for governments to borrow, while high rates increase the cost of debt. This dynamic creates an environment where both entities must navigate each other's actions carefully. Governments must consider how fiscal policies, such as spending and taxation, interact with monetary conditions. Central banks must consider how their decisions affect the broader economic landscape in which governments operate. Despite its power, monetary policy is not a solution to every economic challenge. Central banks cannot build infrastructure, train workers, or innovate industries. They cannot control global events, natural disasters, or technological disruptions. Their influence operates through the financial system, shaping the environment in which other actors, businesses, households, and governments make decisions. The limited, yet profound nature of this influence mirrors the system of money creation itself, indirect, gentle, and rooted in trust. In many ways, monetary policy reinforces the abstraction of money. Because central banks influence credit conditions rather than issuing physical currency, they shape an economy built on expectations and behavior rather than tangible resources. This abstraction does not weaken the system, strengthens it by allowing flexibility, adaptability, and responsiveness. Monetary policy enables societies to navigate uncertainty, adjust to change, and recover from shocks. It supports the continuous cycle of money, creation, and destruction that defines modern banking. The public, whether aware of it or not, feels the effects of monetary policy in daily life. When interest rates drop, mortgages become more affordable, businesses hire more workers, and consumers feel encouraged to spend. When interest rates rise, saving becomes more attractive, borrowing slows. Individuals reevaluate their financial plans. These shifts shape everything from housing markets to the cost of education to the pace of technological adoption. Monetary policy influences society not through directives, but through the quiet reshaping of incentives. Even though the mechanisms of monetary policy operate behind institutional walls, they reflect deep human values: caution, foresight, resilience, and cooperation. Central banks craft policy not to command the economy, but to support it, ensuring that the system of credit remains stable and capable of fulfilling the needs of a growing society. Their decisions embody a commitment to maintaining trust, preserving opportunity, and protecting the future from the volatility of the present. As this part of the narrative settles into its final moments, the world now stands with a clearer sense of how monetary policy guides the invisible flow of money created by banks. Through interest rates, liquidity management, communication, and observation, central banks maintain the rhythm of an economy built on trust and credit. The next part of the story deepens into the interconnected nature of governments, individuals, and banks, revealing how credit cycles shape everyday life and how each participant contributes to the continuous creation and circulation of money. Credit cycles began to form almost as soon as banks started creating money through lending, and over time, they became one of the defining rhythms of modern economic life. These cycles did not arise from deliberate design. They emerged naturally from the way individuals, businesses, and governments interacted with the banking system. When people felt optimistic, they borrowed more. When they borrowed more, banks expanded credit. As credit expanded, Economic activity increased, reinforcing the optimism that started the process. Eventually, confidence would rise too high or imbalances would form, leading to a slowdown. The cycle would then turn, contracting gently or sharply depending on conditions. Through this ongoing rhythm, money created through lending shaped not only financial outcomes but the daily experiences of millions of people. At the heart of every credit cycle lies the interaction between borrowing and spending. When individuals borrow, they gain access to money that did not exist before. They use this money to buy homes, cars, education, and goods that support their lives. Businesses borrow to expand factories, hire workers, or invest in new products. Governments borrow to build infrastructure or support public programs. Each form of borrowing introduces newly created money into the economy. This influx increases demand, encouraging production and investment. Workers receive wages, companies see revenue grow, and households experience rising incomes. The entire system feels energized as credit flows more freely. This expansion phase often feels natural and effortless. People experience rising confidence, believing that the future holds more opportunity. Businesses respond by making ambitious plans. Hiring becomes more frequent and investments rise. Governments may start new projects or expand services, encouraged by the positive environment. Credit creation supports these decisions, multiplying the initial optimism through the financial system. Banks observe increasing demand for loans and are often willing to meet it, viewing the strong economy as a sign that borrowers will be capable of repayment. Yet expansion contains within it the seeds of its eventual slowing. As credit grows, prices often increase. Homes become more expensive, goods rise in cost, and services follow suit. Inflation begins to take hold, not necessarily as a problem, but as a signal that the economy is pushing against its limits. Central banks, observing these developments, may adjust interest rates to prevent overheating. Higher interest rates gently cool borrowing, slowing the expansion of credit. This deliberate moderation represents one of the many ways central banks support long-term stability by guiding the cycle toward balance. The slowdown phase emerges gradually. Demand softens as borrowing becomes more expensive. Businesses begin postponing projects, and households reconsider large purchases. The pace of expansion slows, but the system remains healthy. This cooling does not represent decline. It reflects the natural need for economies to adjust after periods of rapid growth. People shift from expansionary thinking toward caution. They save more, borrow less, and focus on maintaining stability. This phase provides time for imbalances to resolve, for investments to mature, and for prices to stabilize. The economy breathes in and out gently, maintaining its long-term vitality. However, credit cycles do not always remain gentle. At times, imbalances grow too large. Debt accumulates faster than income. Asset prices soar beyond sustainable levels. Borrowers take on obligations that stretch their financial capacity. Businesses expand too quickly. When these imbalances converge, the cooling phase can accelerate into contraction. Banks become cautious, reducing lending. Individuals become hesitant, avoiding new debt. Businesses scale back. The economy shifts from optimism to restraint. Contraction does not erase all progress made during the expansion, but it slows the flow of newly created money, allowing the system to reset. This contraction can feel sharp because it directly affects the availability of credit. When banks reduce lending, the creation of new money declines. Because so much of the money supply depends on lending, this reduction ripples through the economy. People feel the effects when loans become harder to obtain, when businesses slow hiring, or when governments face tighter budgets. The contraction phase reveals how dependent modern systems have become on the continuous creation of credit. Yet, even in these moments, the underlying structure remains intact. Central banks, governments, and financial institutions work together to restore confidence, stabilize markets, and support lending. Their efforts help guide the system back toward balance. Once the contraction reaches its turning point, the stage is set for renewal. As prices stabilize and cautious optimism returns, people begin borrowing again. As businesses restart investments, as governments introduce policies to support growth, banks resume lending, encouraged by improving conditions. This cycle of contraction and renewal reflects the natural flow of credit, the ebb and flow that sustains modern economies. Through it all, money is created and extinguished, circulating through households, industries, and institutions in an ongoing dance shaped by trust and sentiment. The interaction between individuals and banks plays a central role in the credit cycle. When a person decides to take a loan, that decision is influenced by their perception of the future. If they feel secure in their job, confident in their plans, and optimistic about the economy, they are more likely to borrow. When people across a society share this mindset, borrowing increases collectively. This shared sense of optimism becomes the emotional engine that drives expansion. Just as trust in banks supports the system, confidence in the future fuels the flow of credit. Businesses respond similarly. When they expect rise in demand, they invest in equipment, build new facilities, and hire more workers. These decisions often require borrowing. A business's willingness to take on debt reflects its belief in future profits. During expansion, these beliefs spread across industries, reinforcing each other. As companies see others growing and conclude that conditions must be favorable, this collective behavior amplifies the impact of credit creation, turning individual decisions into powerful waves of economic activity. Governments also participate in credit cycles. They borrow to fund projects that support public services, infrastructure, and development. During downturns, governments often borrow more to stimulate the economy, creating demand when private activity slows. Their choices influence the pace of recovery, and their ability to borrow depends on confidence in their long-term stability. Just as individuals and businesses rely on trust, governments depend on credibility. When the public believes in their ability to manage debt responsibly, governments can borrow at lower costs, supporting recovery more effectively. The interdependence among individuals, businesses, and governments creates a feedback loop that shapes the entire economy. As groups' decisions influence the others, and all rely on the banking system to facilitate the creation of credit. This interdependence strengthens the system, but also creates vulnerabilities. When confidence falters due to economic shocks, financial crises, or external events, the entire cycle can shift abruptly. Central banks work to prevent such abrupt shifts, using monetary policy to smooth transitions and maintain balance. Their role becomes especially important during moments when fear threatens to overwhelm trust. The psychological dimension of credit cycles cannot be overstated. Emotions like optimism, fear, caution, and confidence play as significant a role as interest rates or bank reserves. People's beliefs about the future shape their financial decisions. These decisions influence the creation of money. Money, once created, affects the real economy, reinforcing or dampening the emotions that guided the decisions in the first place. This cycle of emotion, decision, and outcome becomes a quiet force guiding the movement of credit. Economists study data, but the invisible undercurrent of sentiment often explains the turning points. The impact of credit cycles extends beyond economics into everyday life. During periods of expansion, people feel secure. They plan for weddings, enroll in education programs, or pursue long-held dreams. Communities invest in growth, neighborhoods flourish. During contractions, the mood shifts. People become more cautious. They prioritize essentials, reduce spending, and focus on stability. These shifts influence everything from housing markets to job opportunities, shaping the emotional and social landscape of society. Credit cycles also guide generational experiences. Younger generations may come of age during expansion, learning to expect opportunity and upward mobility. Others may reach adulthood during contraction, developing cautious attitudes toward borrowing and spending. These generational patterns influence culture, shaping values around risk, security, and ambition. The cycle, though economic in nature, becomes deeply personal, affecting how individuals perceive the world and their place within it. As the story of credit cycles unfolds, it becomes clear that the system of money creation is not mechanical, but organic. It pulses with the emotions, decisions, and expectations of millions of participants. It responds to pressures from inside and outside the economy. It grows, contracts, and grows again, guided by trust, shaped by institutions, and supported by the steady frameworks provided by central banks. As this part of the narrative comes to rest, the world stands with a deeper understanding of how interconnected individuals, businesses, and governments become through credit cycles. Their decisions form the continuous creation of money that fuels economic life. The next part of the story explores how these invisible forces shape human psychology, influencing perceptions of stability, safety, and the meanings people assign to money itself. Psychology surrounding money creation is as influential as the mechanics behind it. Even though most people never see the inside of a bank's balance sheet or study the details of monetary policy, they live within an emotional landscape shaped by the invisible movements of credit. This landscape quietly influences how people feel about safety, opportunity, and the passage of time. It guides their reactions to economic news, their sense of security in daily life, and the expectations they carry into the future. The psychological dimension of money does not appear in ledgers or statements, yet it determines how the entire system functions. It transforms abstract numbers into lived experience, weaving the world of finance into the intimate spaces of human thought and emotion. For many individuals, the first encounter with money is not through physical cash, but through observation. Parents paying bills, workers receiving wages, or relatives discussing finances. These early impressions shape a sense that money is something both necessary and mysterious. Children understand that money allows families to buy food, travel, or access services, but they rarely grasp the mechanisms behind it. This early understanding grows into adult beliefs that money exists in fixed quantities, stored securely in accounts or exchanged for goods. The idea that banks create money through lending remains hidden beneath the surface, replaced by a mental model grounded in simplicity and stability. This gap between perception and reality becomes a central feature of financial psychology. Adults carry these early impressions into their interactions with the banking system. They view bank balances as representations of personal effort, discipline, and security. Seeing numbers rise evokes a sense of accomplishment. Seeing them fall triggers caution or anxiety. The emotional connection to money gives numerical values symbolic meaning far beyond their economic function. A savings account becomes a buffer against uncertainty. Loan becomes a commitment to the future, and credit becomes a measure of trustworthiness. These emotional associations influence how people respond to the credit cycles that shape the economy. During periods of economic expansion, when credit flows easily and opportunities appear abundant, people feel a deep sense of optimism. They see rising incomes, expanding businesses, and growing markets as signs that the future will be better than the present. This optimism permeates decisions about borrowing and spending. Individuals may purchase homes, pursue education, or start businesses with confidence that their future selves will be able to meet the obligations. This belief is psychological as much as financial. It reflects a sense of participation in a growing, dynamic system. The rising optimism also influences how communities perceive themselves. Neighborhoods undergoing development feel energized with new shops, homes, and public spaces appearing. Workers feel more secure in their jobs. Families feel encouraged to make long-term plans. These collective emotions reinforce the expansion phase of the credit cycle, creating a feedback loop in which psychological confidence inspires economic activity, and economic activity reinforces confidence. However, the same psychological processes that support expansion can also contribute to vulnerability. When optimism grows unchecked, people may underestimate risk. They may borrow more than they can comfortably repay or invest in ventures that rely too heavily on continued growth. Businesses may expand too rapidly, stretching resources thin. Governments may build budgets around assumptions of sustained revenue. These behaviors reflect the emotional momentum of optimism, which can lead to an overextension of credit. When expansion shifts into slowdown, people often experience confusion or frustration as their expectations collide with changing conditions. The transition from optimism to caution reveals the subtle emotional fragility within the system. As borrowing slows and credit contracts, individuals may feel uncertainty about their plans. A once confident borrower becomes hesitant to take new debts. A business owner begins to worry about sustaining growth. A government revises spending priorities. These shifts are not rooted solely in financial calculations. They reflect the emotional impact of changing economic signals, news reports, market trends, discussions within communities. People feel the ripple effects of contraction before they see the data. Fear often emerges during sharper downturns, even before conditions become severe. Fear alters perception. People focus more on risk, less on possibility. They become more sensitive to uncertainty and more cautious in their decisions. Fear does not operate uniformly across society. Individuals react quickly, reducing spending or avoiding new commitments. Others continue their routines but carry a subtle sense of unease. This mixture of reactions shapes the emotional tone of the economy, influencing borrowing patterns and slowing the creation of new money. The psychological effects of fear become particularly visible during financial crises. When trust falters, people may question whether their money is safe, whether banks will honor commitments, or whether the economy can recover. Fear spreads through conversations, news, and social networks, amplifying the impact. What begins as a technical issue within the financial system becomes a shared emotional experience. Even individuals with secure finances feel the tension, sensing that something invisible has shifted beneath the surface. In these moments, central banks and governments often focus not only on financial stability, but on psychological reassurance. Clear communication, supportive policies, and visible interventions aim to restore confidence. These efforts acknowledge that economic recovery depends as much on belief as on balance sheets. When people see that institutions are acting decisively, their fear gradually diminishes. Confidence rebuilds slowly, becoming the foundation for renewed borrowing, spending, and growth. The psychological landscape of money also shapes how people understand value. Because so much money exists in digital form, people rely on trust rather than tangible evidence. The numbers on screens become symbols of security, while the lack of physical substance reinforces the abstract nature of financial life. This abstraction can create both comfort and discomfort. For some, digital money feels convenient and modern. For others, its intangibility evokes a sense of fragility. Its perceptions influence how people respond to changes in wealth, risk, and uncertainty. The way people experience wealth also shapes their emotional relationship with money. Wealth creates feelings of independence, stability, and opportunity. It can reduce anxiety about the future and enable long-term planning. Yet, wealth can also generate pressure to maintain a certain lifestyle. Pressure to use resources wisely, or pressure to preserve value in unpredictable conditions. These psychological factors influence saving and spending decisions, reinforcing broader economic patterns. Debt carries its own emotional weight. For some borrowers, debt represents empowerment. It provides access to education, housing, and investment. For others, debt evokes tension or responsibility, especially when repayment becomes challenging. These emotional responses shape how people approach credit. A person who views debt positively may pursue opportunities with confidence. A person who feels anxious about debt may hesitate, even when borrowing would support long-term growth. These differences contribute to the diversity of behaviors that drive credit cycles. Money also influences identity. People often associate financial stability with personal success and instability with personal insecurity. These associations shape self-esteem, stress levels, and long-term decision-making. When people feel financially secure, they express greater optimism about their abilities and the world around them. When they feel insecure, their sense of possibility narrows. These emotional states influence how individuals engage with the economy, how they plan for the future, and how they interpret financial events. The psychological meaning of money extends beyond individuals into families and communities. Money becomes intertwined with cultural expectations, social norms, and generational values. Some communities emphasize saving and caution, viewing debt as something to avoid. Others encourage borrowing for investment or growth. These cultural patterns influence how credit cycles unfold within different regions, shaping the overall flow of money creation. As people navigate the financial system, they carry these psychological influences with them. Every decision, whether to take a loan, invest in a business, or save for the future, arises from a combination of logic and emotion. A balance between these forces shapes the broader economy. Money creation depends on human behavior, and human behavior depends on psychological perception. The financial system is therefore as emotional as it is mathematical, as human as it is institutional. The invisible forces that shape perceptions of stability also guide the meaning people assign to money. For some, money represents security. For others, freedom. For still others, opportunity or responsibility. These meanings influence how money is used and how people react to its creation or destruction. The psychological landscape becomes a quiet but constant presence, guiding the flow of money through society. As this part of the story approaches its closing breath, the world stands with a clear understanding of how deeply psychology shapes modern finance. The creation of money is not merely a technical process, but a human one, intertwined with emotion, belief, and perception. In the next part of the narrative, the focus widens to show how the global financial system merges these psychological forces with technological and cultural changes, creating an interconnected world where money flows across borders as easily as thoughts and ideas. The global expansion of money creation emerged gradually, shaped not by a single decision or discovery, but by countless interactions across borders, cultures, and institutions. As nations developed, they found that their financial systems were not isolated islands, but interconnected networks through which money, credit, and expectations moved freely. This interconnectedness transformed the role of banks, governments, and central authorities, extending the influence of credit creation beyond national boundaries. It created a world where a decision made in one country could send ripples across oceans, affecting distant markets and shaping the circumstances of people far removed from its origin. The global nature of money creation did not make the system more chaotic. It made it more unified, more responsive, and more dependent on cooperation. The first seeds of global financial integration were planted through international trade. Long before digital systems and instantaneous communication, merchants exchanged goods across continents, carrying currency, promissory notes, and letters of credit. These instruments allowed traders to do business without transporting large amounts of metal. The notes represented trust between merchants, often guaranteed by banks in distant cities. This trust crossed borders, connecting communities that had never met. Over time, these early financial bridges grew stronger, supporting larger transactions and linking more participants in the growing network of global commerce. As transportation and communication improved, the connections deepened. Banks established branches in foreign countries, offering services to travelers, businesses, and governments engaged in international trade. These branches became nodes in a global web of financial relationships, facilitating transactions across regions and allowing money to flow more freely than ever before. Each connection strengthened the system, making it possible for credit created in one part of the world to support economic activity in another. The emergence of multinational banking institutions signaled a shift from local financial ecosystems to a planetary network of interdependent credit flows. This interdependence intensified with the development of foreign exchange markets. Because countries issued their own currencies, traders needed a way to convert one currency into another. Banks filled this need by buying and selling currencies, creating a global marketplace for money itself. Exchange rates became signals through which markets interpreted economic conditions, reflecting the relative strength and trustworthiness of each nation's financial system. As these exchange markets grew, they connected central banks, commercial banks, investors in a complex rhythm of flows. Money creation no longer affected only local economies. It influenced exchange rates, capital flows, and global investment patterns. The expansion of international banking also changed how credit cycles unfolded. A boom in one country could attract investment from abroad, intensifying the local expansion. A downturn in one region could lead investors to withdraw funds from others, amplifying contraction. These movements created global credit cycles patterns of growth and slowdown that crossed national borders. Central banks began coordinating policies to manage these global dynamics, recognizing that isolated efforts were insufficient in a world of interconnected financial flows. Their communication, collaboration, and coordinated responses became essential for maintaining stability. As global trade increased, so did the demand for international investment. Banks and financial institutions began lending across borders, financing infrastructure, industry, and development in distant regions. These investments brought new opportunities, but also new vulnerabilities. When global finance operates smoothly, it supports growth everywhere. But when disruptions occur, the interconnectedness can amplify risk. A shock in one market may cause uncertainty in others, triggering reassessments of risk, liquidity shortages, or changes in investment patterns. This interdependence created a world where stability required coordination, trust, and shared principles across nations. The rise of digital technology accelerated this interconnectedness dramatically. Money became increasingly abstract, represented not by physical currency, but by digital entries in global databases. Transactions that once took days now occur in seconds. Investments move at the speed of thought, crossing borders with a keystroke. Global markets operate continuously, influenced by news, data, and sentiment from every corner of the world. The digital nature of modern finance allows banks to communicate instantly, settle transactions across continents, and coordinate responses to emerging challenges. This technological integration strengthened the network, but also increased the pace at which information and emotion influenced the system. Digital technology also introduced new tools for risk management, analysis, and coordination. Banks use complex algorithms to assess creditworthiness, monitor global trends, and identify potential vulnerabilities. Central banks use models to simulate economic scenarios and design policies that respond to global conditions. Investors use software to allocate resources across markets in real time. These tools enhance the efficiency and resilience of the global system while deepening its interconnectedness. They allow money creation to flow smoothly across borders, but also tie global markets more tightly to shared patterns of behavior and expectation. The global nature of money creation has not erased differences between countries. It has woven them together. Each nation still issues its own currency, maintains its own central bank, and manages its own economy. But the flows of credit that pass between them create a shared financial environment. A decision by one central bank to change interest rates may influence the policies of others. A shift in borrowing patterns in one region may affect investment flows across the world. Nations become participants in a collective rhythm where each movement shapes the whole. One of the most profound effects of this interconnectedness is the way it influences global development. Countries with access to international credit can build infrastructure, expand industries, and support public services. They can borrow resources from the future in order to shape the present. This ability to access global credit enhances opportunity, but it also creates responsibility. Nations must manage their debt, maintain credibility, and ensure the stability of their financial institutions. The trust that supports global lending extends beyond individuals and businesses to entire governments, shaping how nations interact with one another. The global financial system also influences migration, education, and cultural exchange. Money created in one region supports businesses in another, which may attract workers, students, or tourists. Remittances sent by individuals working abroad flow back to their home countries, supporting families and local economies. These flows of money shape the lives of millions, creating connections that transcend geography. The global system becomes not just a financial structure, but a bridge between cultures, creating networks of opportunity that span continents. The interconnected nature of money creation also means that global cooperation becomes an essential part of stability. Central banks communicate regularly, sharing data and coordinating responses to global challenges. Financial institutions collaborate to maintain liquidity and prevent systemic disruptions. International organizations monitor economic health, provide guidance, and offer support during crises. This cooperation reflects the understanding that the financial well-being of one region is linked to the stability of others. The global system becomes a shared responsibility, supported by institutions that recognize the interconnected nature of modern economies. Despite its complexity, the global financial system retains the same foundation as its earliest forms: trust. Trust between nations, trust between institutions, trust between individuals and the system that surrounds them. Without trust, the interconnected system would fracture into isolated fragments. With trust, it becomes a resilient network capable of supporting billions of lives. As the world continues to evolve, the interconnectedness of money creation continues to expand. Technology advances, communication speeds increase, and global relationships deepen. The financial system adapts, adjusting its rhythms to reflect new realities. Yet the fundamental process remains unchanged. Banks create money through lending, guided by trust, shaped by policy, and influenced by human behavior. The global system becomes the stage upon which this continuous creation unfolds. As this part of the narrative rests, the world now stands with a quiet appreciation of how money created within individual banks becomes part of a vast, interconnected flow that binds nations together. The next part explores how technology continues to reshape this global system, introducing new forms of money, new ways of transferring value, and new expectations about what financial stability means in an increasingly digital world. The emergence of new technology has begun to reshape the financial world with a gentle but undeniable force, altering not only how money moves, but what money itself can become. The transformation did not arrive suddenly. It began as a series of small improvements: faster communication, safer storage of data, and digital interfaces that replaced paper records. Over time, these improvements accumulated into a new environment where financial transactions lost their physical form almost entirely. The shift to digital money was not merely a matter of convenience. It marked a profound change in how societies understand value, trust, and the mechanisms that support economic life. The digital age introduced new possibilities for creating, storing, and transferring money, expanding the boundaries of the global financial system. At first, digital money existed simply as electronic versions of traditional currency. As people used cards instead of cash, banks recorded balances electronically instead of on paper, and payments traveled across networks instead of through physical exchange. This transition appeared subtle, but it fundamentally changed the nature of money. Instead of being tied to physical objects or printed notes, money became pure information numbers stored in secure databases and updated through encrypted messages. This shift made transactions faster. A payment that once required days of processing could now be settled in minutes or seconds. It also made transactions more precise, leaving a detailed trail that improved oversight and transparency. The rise of online banking accelerated this transformation. Customers could view balances, transfer funds, and manage accounts without visiting a branch. Banks adapted to this new environment by investing in digital infrastructure and rethinking their operations. New forms of financial interaction emerged: online payments, automatic transfers, and digital invoices that replaced many traditional routines. These innovations created a more seamless relationship between consumers and financial institutions, reinforcing the abstraction of money and increasing the speed at which credit could circulate through the system. Mobile technology intensified the shift. When people began carrying smartphones, they gained constant access to financial tools. Payments could be made with a tap, transfers could be initiated from anywhere, and financial information could be monitored continuously. This mobility eliminated many of the delays that once shaped financial life. The immediacy of digital interaction increased people's sense of control over their money, even as the underlying systems grew more complex. The convenience of digital payments also encouraged more frequent transactions, accelerating the movement of money and expanding opportunities for commerce. As digital systems grew more sophisticated, new players entered the financial space. Technology companies, online platforms, and fintech firms began offering services traditionally provided by banks. These new institutions leveraged advanced software, data analysis, and innovative interfaces to provide fast, user-friendly financial services. They offered digital wallets, peer-to-peer payment systems, small business loans, and automated investment platforms. Their presence increased competition, encouraging traditional banks to modernize their systems and broaden their offerings. The financial landscape became more diverse, with a wider range of institutions participating in money creation, credit distribution, and payment processing. The rise of digital platforms also expanded global financial access. People who once lacked formal banking services could now participate in the financial system through mobile accounts or digital wallets. Small businesses gained the ability to receive payments electronically, giving them greater reach and flexibility. This inclusion strengthened local economies, increasing the flow of money and credits in regions previously underserved. As technology lowered barriers, financial participation broadened, reinforcing the principle that the creation and movement of money depend on access, trust, and interconnected systems. The most dramatic shift in modern finance began with the emergence of cryptocurrencies, digital assets created through mathematical processes rather than through traditional banking. These new forms of money challenged the long-standing idea that currency must be issued by governments or backed by institutions. Cryptocurrencies exist as decentralized records maintained across global networks, independent of any single authority. Their value arises from the trust placed in the system itself, supported by cryptographic security and transparent algorithms. While volatile and experimental, cryptocurrencies introduced a new vision of money as something programmable, borderless, and independent of traditional institutions. The underlying technology behind cryptocurrencies, blockchain, introduced ideas that extended far beyond digital money. Blockchain provided a way to record transactions in a distributed, tamper-resistant ledger. This technology enabled new forms of financial interaction, such as decentralized finance, where lending and borrowing occur without intermediaries. It inspired innovations in identity verification, supply chain tracking, and contract execution. Blockchain demonstrated that the architecture of money could evolve, guided not only by central institutions, but by networks of participants across the world. Despite the rise of cryptocurrencies, Central banks maintained their essential role in financial stability, but the innovations in digital technology encouraged them to explore new possibilities. Central bank digital currencies, CBDCs, emerged as a concept that combined the trust of national institutions with the efficiency of digital systems. A CBDC would represent a digital version of a nation's currency, issued and backed by its central bank, accessible directly through digital platforms. Such currencies could provide greater security, faster payments, and improved financial inclusion. They could also give central banks more precise control over monetary policy, enabling them to respond more effectively to economic changes. The development of CBDCs reflects a broader trend, the blending of traditional financial structures with modern technology. This blending has expanded central banks' ability to monitor financial conditions, regulate institutions, and coordinate globally. Advanced data systems allow central banks to analyze economic activity with greater depth and speed. Artificial intelligence helps detect risks within financial networks. Digital communication enables faster coordination across borders. The integration of technology has strengthened the global financial system's capacity to adapt to changing conditions. Technology has also changed how individuals perceive money. The ability to move funds instantaneously, invest with a few taps, or send payments across borders has created a sense that money is fluid and accessible. People experience financial life through apps, screens, and digital dashboards, which shape their expectations about speed, convenience, and control. This new perception influences behavior, increasing the pace at which money circulates and elevating the importance of digital literacy. Technology has made the financial system feel both more personal and more abstract, blending intimacy with complexity. The digitization of money also shapes how people understand risk. As transactions occur within digital systems, concerns about cybersecurity, fraud, and data privacy become more prominent. Individuals and institutions invest in protective measures, recognizing that the financial system's strength depends not only on trust, but on the integrity of digital infrastructure. New forms of risk require new forms of vigilance, and technology continues to evolve to meet these challenges. Global finance, once centered on physical movement and personal relationships, now operates within a digital network that spans the planet. Financial markets respond instantly to news and events. Investors track data across regions. Capital flows through algorithms that analyze trends and adjust positions in real time. This immediacy increases efficiency, but also heightens sensitivity. How changes in one region can influence markets worldwide in minutes, reinforcing the interconnected nature of modern money creation. Despite this speed and complexity, the foundation remains familiar. Banks still create money through lending. Central banks still guide liquidity. Governments still rely on credit to fund development. People still depend on financial systems to support their lives and aspirations. Technology has changed the appearance and mechanics of finance, but not its fundamental structure. Money remains a creation of trust, shaped by collective decisions and sustained by shared expectations. The integration of technology into global finance also introduces a deeper philosophical question. What should money be in the future? Should it remain a tool controlled by institutions? Should it become more decentralized, shaped by open networks? Should it remain a public good or evolve into multiple forms reflecting diverse purposes? These questions do not have immediate answers, but they reflect the ongoing evolution of money as societies adapt to new technologies and new ways of thinking. As this part of the narrative settles, the world now sees how technology has woven itself into the global rhythm of money creation. It has expanded possibilities, increased speed, and reshaped expectations. Yet beneath the innovation, the system remains rooted in trust, cooperation, and the basic principles that have guided money for centuries. The next part of the journey explores how these innovations influence stability. examining the balance between resilience and vulnerability in a digital, interconnected financial world. The stability of the global financial system rests upon a delicate balance, one shaped by the interaction between ancient principles of trust and modern forces of speed, technology, and interdependence. As money has become increasingly digital and interconnected, the system has grown both more resilient and more vulnerable. A. It is resilient because information moves quickly, coordination improves, and institutions can respond faster than ever before. It is vulnerable because speed amplifies emotion, interconnection spreads risk, and digital systems introduce complexities that did not exist in earlier eras. Stability in this environment is not a fixed state, but a continuous process and ongoing effort to maintain confidence, manage uncertainty, and guide the flow of money in a way that supports long-term balance. One of the foundational risks in the modern financial world arises from the sheer speed at which information travels. Markets respond instantly to news, predictions, and rumors. A headline can move billions of dollars within seconds. A shift in sentiment can cascade through global networks. This speed creates a situation where emotion and reaction can outpace thoughtful analysis. Central banks and financial institutions understand this dynamic deeply. They recognize that maintaining stability depends not only on policy tools, but on careful communication that prevents unnecessary alarm. Their messages must be clear, measured, and reassuring, because in the digital age, uncertainty can travel faster than clarity. The interconnectedness of global finance also introduces new forms of vulnerability, because banks, markets, and institutions are linked across borders. A disturbance in one region can ripple outward. A decline in one market may prompt investors to reduce exposure elsewhere. A shift in interest rates in one country may influence capital flows across continents. This interdependence means that stability must be viewed as a shared responsibility. Nations cannot afford to ignore global conditions, nor can institutions assume that local strength will shield them from external shocks. The financial system operates like an intricate web, where tension in one strand affects the entire structure. At the same time, this interconnectedness strengthens resilience. It allows nations to support one another during crises, providing liquidity, coordinating policies, stabilizing markets. International organizations facilitate communication and cooperation. Central banks share data, synchronize responses, and offer cross-border assistance when needed. Financial institutions diversify their investments, spreading risk across regions rather than concentrating it in one place. This collaborative framework expands the system's capacity to absorb shocks, preventing disruptions from escalating into widespread failures. Another source of vulnerability lies in the complexity of modern financial instruments. Derivatives, debt securities, structured products, and algorithm-driven trading strategies all contribute to the flow of credit and liquidity. These tools provide flexibility, allowing investors to manage risk, hedge exposure, and allocate capital efficiently. Yet their complexity can obscure the true nature of risk, making it harder to assess where vulnerabilities lie. When markets operate smoothly, these instruments enhance stability. When stress emerges, their interconnected structures can transmit risks quickly, creating challenges for regulators and institutions. The stability of the system depends on understanding these tools, monitoring their interactions, and ensuring that transparent rules govern their use. Cybersecurity has become one of the most significant challenges of the digital era. As money exists increasingly as information, the system becomes dependent on the integrity of digital records and communication networks. Cyberacts pose a threat not only to individual accounts, but to entire financial infrastructures. Banks, central banks, and payment systems invest heavily in protection, recognizing that trust in digital money requires absolute confidence that records cannot be altered, stolen, or erased. This protective effort extends across borders, with institutions collaborating to share insights, detect threats, and defend the global system. Cybersecurity illustrates that stability depends not only on economic soundness, but on technological resilience. The role of central banks has expanded in response to these evolving challenges. They serve as guardians of stability, monitoring markets, analyzing risks, and intervening when necessary to maintain confidence. During periods of stress, central banks use lending facilities, liquidity injections, coordinated actions to support the financial system. They aim to prevent temporary fears from becoming systemic failures. Their interventions often operate quietly, providing support beneath the surface while allowing markets to function normally. This subtle guidance reinforces the trust upon which the financial system depends. Governments also play a crucial role in stability. Their fiscal policies influence economic conditions, employment, and public investment. During downturns, governments may increase spending or reduce taxes to support growth. During expansions, they may focus on debt management and long-term planning. These decisions affect borrowing needs, which in turn influence global credit flows. The relationship between fiscal and monetary policy shapes the environment in which banks create money, affecting everything from interest rates to investment patterns. Coordination between central banks and governments becomes essential during periods of uncertainty, ensuring that their actions reinforce rather than contradict one another. The stability of the financial system also depends heavily on public confidence. People must believe that their money is safe in banks, that payments will clear, and that institutions will honor their obligations. Confidence is not built through complex theories or technical explanations. It arises from daily experiences, the ability to withdraw cash, transfer funds, pay bills, or use digital services without issue. When these routines function smoothly, confidence grows. When disruptions occur, people become alert to signs of trouble. Central banks and regulators understand the importance of maintaining these everyday interactions, recognizing that stability begins with the trust of individuals. The psychological dimension of stability extends beyond daily transactions. People interpret financial news, economic trends, and government announcements through the lens of personal experience and expectation. When they sense stability, they spend more, invest more, and borrow with confidence. When they sense instability, they become cautious. These collective behaviors shape the rhythm of credit creation. Stability, therefore, depends on clear communication, timely intervention, and an environment where people feel supported and secure. The emotional landscape becomes an invisible yet powerful force guiding the system. Cultural differences also influence perceptions of stability. Some societies place great emphasis on saving, viewing caution as a virtue. Others emphasize investment and entrepreneurial risk-taking. These cultural patterns shape how credit cycles unfold within each region, influencing borrowing, spending, and investment. They also shape how people respond to downturns, whether with resilience, anxiety, or opportunistic innovation. Understanding these differences helps institutions support stability across diverse populations. Technological innovation introduces new opportunities for stability. Real-time data allows institutions to detect early signs of stress. Digital tools enable faster transactions and more flexible risk management. Artificial intelligence helps identify patterns that were once invisible. These innovations enhance the system's ability to adapt, respond, and adjust. Yet, they must be used carefully, with awareness of potential unintended consequences. Technology amplifies both strength and vulnerability, requiring thoughtful integration into the financial system. Stability also depends on inclusiveness. When people lack access to financial services, they remain vulnerable to shocks and unable to participate fully in the economy. Digital finance has expanded access, enabling millions to store money, receive payments, and build financial histories. This inclusion strengthens communities, supports development, and stabilizes local economies. As financial access expands, the entire system becomes more resilient. benefiting from broader participation in shared opportunity. Environmental, geopolitical, and social factors also influence stability. Natural disasters disrupt economies. Geopolitical tensions affect trade and investment. Social movements reshape priorities and expectations. The global financial system must navigate these forces, adapting policy and practice to changing conditions. Institutions engage in long-term planning, stress testing, and scenario analysis to prepare for these uncertainties. Their goal is to ensure that the system remains stable even when the world experiences unpredictable shifts. The concept of stability itself continues to evolve. It is no longer defined merely as the absence of crisis. It encompasses adaptability, inclusiveness, transparency, and resilience. Stability means maintaining trust, even during uncertainty. It means preserving the flow of credit, even when conditions shift. It means ensuring that money continues to move through households, businesses, and institutions in a way that supports human well-being. As this part of the narrative settles, the world now sees that stability in the modern financial system is a dynamic balance supported by technology, cooperation, communication, and human behavior. It is shaped by institutions, but sustained by belief. The next part of the journey explores how these forces influence inequality, revealing how the system distributes opportunity and how the creation of money affects different groups within society in subtle and powerful ways. The distribution of money created through lending has never been uniform. And as the financial system has grown more complex, the patterns of inequality shaped by credit have deepened in ways that are subtle, structural, and often invisible. Inequality does not arise from a single cause. It emerges from the interaction between opportunity, access, trust, and the institutional architecture that guides money creation. As banks extend credit, they do so based on assessments of risk, collateral, and repayment capacity. These assessments, though designed to be rational, inevitably reflect the inequalities already present in society. People with greater resources gain easier access to loans. People with fewer resources face higher barriers. Over time, this uneven access shapes wealth, mobility, and stability across generations. At the core of this dynamic lies the role of collateral. Borrowers who possess assets, a home, a business, savings, or investments can use them as guarantees to secure loans. This access allows them to borrow at lower rates, invest in opportunities, and build wealth. Those who lack collateral must either borrow at higher costs or cannot borrow at all. Their financial lives depend more heavily on income, which may fluctuate or remain insufficient for significant investment. This difference creates a quiet divide between those who can leverage the future and those who remain constrained by the present. Credit scores and financial histories add another layer of separation. These metrics summarize a person's financial past, transforming years of behavior into numerical signals that influence the cost and availability of credit. Individuals with long histories of steady payments receive favorable terms. Those with limited histories, past struggles, or irregular incomes face obstacles. The metrics themselves are not designed to discriminate. Yet, they reinforce existing inequalities by rewarding stability that many are never afforded the chance to build. The cycle becomes self-reinforcing without credit. Individuals struggle to establish financial strength, and without financial strength, they struggle to obtain credit. Income inequality further amplifies these patterns. Higher income individuals can save more, invest more, and withstand unexpected expenses. Their stability reduces risk for lenders, making credit more accessible. Lower income individuals often face volatile incomes, limited savings, and greater exposure to financial shocks. These conditions increase the perceived risk of lending to them, raising borrowing costs or restricting access. The system does not intend to favor one group over another, simply evaluates risk without acknowledging the structural factors that shape it. The result is a persistent disparity in who benefits from money creation. Businesses experience similar dynamics. Large companies with established reputations, valuable assets, predictable cash flow can borrow easily to expand operations, hire workers, or develop new products. Smaller businesses, particularly new or family-owned ones, face more difficulty. They may lack collateral, financial history, or steady revenue. As a result, they pay higher interest rates or struggle to access loans at all. This disparity influences the competitive landscape, allowing large corporations to grow rapidly while small businesses must navigate a narrower path. In many economies, small businesses form the backbone of local communities, yet they operate within a system that offers them fewer advantages. The global dimension of inequality adds additional complexity. Wealthier countries have strong institutions, stable currencies, and deep financial markets, allowing them to borrow easily and at low cost. Developing countries face higher interest rates, more volatile capital flows, and greater sensitivity to global conditions. When they borrow in foreign currency, they become vulnerable to exchange rate fluctuations. When global investors shift preferences, developing countries may experience sudden capital outflows. These dynamics reflect the interconnected nature of global finance, where trust plays a central role in determining opportunity and vulnerability. These inequalities shape everyday life. The ability to purchase a home, pursue education, or invest in a business depends heavily on access to credit. People with fewer resources pay more to borrow money, leaving them with less to save or invest. Over time, these differences accumulate into significant disparities in wealth. Wealthier individuals and communities benefit from compounding returns, appreciating assets, and financial stability. Others remain trapped in cycles where progress is slow, fragile, or continually disrupted. The interaction between inequality and credit also influences how people experience economic cycles. During expansions, those with access to credit benefit more, investing in assets that increase in value. During contractions, those without buffers experience sharper hardship. They may lose jobs, struggle with debt, or face rising living costs without the protection of savings. These contrasting experiences deepen the emotional divide between groups, shaping perceptions of stability, fairness, and possibility. Inequality becomes not just financial, but psychological. Despite these challenges, the financial system contains mechanisms that aim to broaden access. Governments introduce programs to support homeownership, small business lending, and education financing. Central banks promote policies that encourage inclusive growth. Financial institutions develop products designed for underserved communities. These efforts recognize that stability and prosperity depend on broad participation, not on the concentration of opportunity. When more people have access to credit, economies grow more evenly, communities strengthen, and the system becomes more resilient. Technological innovation has introduced new possibilities for reducing inequality. Digital financial services allow people to open accounts, receive payments, and access credit with fewer barriers. Mobile banking reaches communities that traditional institutions often overlooked. Microfinance provides small loans to entrepreneurs in developing regions, supporting local businesses and fostering economic independence. Peer-to-peer lending platforms create opportunities for individuals to borrow without traditional intermediaries. These innovations expand the boundaries of financial inclusion, offering tools that can gradually reduce disparities. However, technology also introduces new challenges. Digital access requires reliable internet, familiarity with digital platforms, and cybersecurity awareness. Those without these resources may find themselves excluded from the very systems designed to increase inclusion. Algorithms used to assess creditworthiness may unintentionally reflect biases in the data from which they learn. While technology holds promise, it must be integrated thoughtfully, with awareness of the structural patterns it may replicate or reinforce. Education plays a vital role in addressing inequality. Financial literacy influences how people navigate the system, understand risks, and make decisions about saving, borrowing, and investing. Without access to knowledge, individuals may struggle to use credit effectively or protect themselves from financial harm. Educational initiatives strengthen the foundation upon which financial well-being grows, empowering people to participate more fully in the economy. Over time, improved financial literacy can reduce disparities in wealth accumulation and access to opportunity. Inequality also shapes political and social dynamics. Communities with limited access to credit may feel disconnected from the broader economic system, perceiving it as distant or unresponsive. These perceptions influence voting patterns, public debates, and expectations about government policy. Inequality influences how societies allocate resources, prioritize public investment, and design safety nets. Economic disparities become woven into the fabric of civic identity, influencing how people understand fairness, responsibility, and collective purpose. Despite these complexities, inequality is not a fixed or inevitable outcome. The financial system has evolved over centuries, adapting to new conditions and incorporating reforms that increase fairness. Governments and institutions continue to explore policies that support inclusive, growth-progressive taxation, education, funding, targeted credit programs, and social support systems. Central banks increasingly recognize the importance of inclusive stability, designing policies that promote broad participation rather than narrow benefit. While inequality reflects deep structural forces, it can be influenced by deliberate effort, cooperative institutions, and evolving social values. The emotional dimension of inequality is profound. People compare themselves not only to their past, but to others around them. These comparisons influence personal satisfaction, ambition, and well-being. Inequality can create feelings of frustration or aspiration, depending on context. It can encourage innovation and resilience, or generate resentment and stagnation. The emotional impact extends to entire societies, shaping cultural narratives about success, opportunity, and fairness. These narratives influence how people engage with the financial system, how they view credit, and how they interpret economic changes. Money creation continues to shape wealth and opportunity. Understanding inequality becomes essential for guiding the system toward a more balanced future. The distribution of credit influences the distribution of possibility. When credit flows broadly, societies flourish more evenly. When it concentrates in specific sectors or demographics, disparities widen. Policymakers, institutions, and communities recognize this reality, and they work to design systems that allocate opportunity more fairly. About this part of the narrative slowly settles. The world sees that inequality is not merely a financial outcome, but an intricate interplay between credit, trust, opportunity, and perception. The next part explores how this system influences daily life in more intimate ways, shaping not only wealth and opportunity, but the rhythms of work, security, and personal identity that define the human experience within a credit-driven world. The influence of money creation reaches deeply into the rhythms of everyday life, shaping not only large economic outcomes, but the intimate textures of work, security, identity, and personal routine. Most people do not think about banks creating money when they wake each morning or plan their week, yet the effects surround them quietly. Credit influences the cost of housing, the stability of employment, the availability of opportunities, and the emotional sensations of safety and uncertainty. It plays a role in how people form families, build careers, pursue dreams, or face setbacks. The financial system is often discussed as something distant or abstract, but it manifests constantly in small decisions, private reflections, and the flow of relationships that fill ordinary days. Work is one of the most immediate ways in which money creation shapes life. Businesses hire workers based on access to credit and expectations of future demand. When credit is abundant and borrowing is easy, companies expand, take risks, and add new positions. This expansion creates job opportunities that might not otherwise exist. People find roles aligned with their skills or aspirations, and they feel encouraged to plan ahead. Their routines fill with purpose as they integrate into the broader economic system. Conversely, when credit tightens and borrowing slows, businesses pause their expansion. Hiring becomes selective. Raises may be delayed, and employees may feel a subtle shift in workplace atmosphere. Conversations become quieter. Managers monitor budgets more closely, and workers sense that the environment around them is changing, even if they do not know why. The experience of employment is shaped further by the stability of income. For many, income provides the central pillar of financial life, determines whether bills can be paid, whether savings can accumulate, and whether long-term plans feel attainable. When credit cycles support strong employment, people feel secure. They can imagine futures with more clarity. They can save for a home, pursue education, or support children with confidence. When cycles weaken, the emotional landscape shifts. Individuals may feel uncertainty about job security or pressures to adjust spending habits. Even if their own position remains stable, they may notice changes around them, friends searching for work, businesses closing, or communities discussing tightening conditions. Housing represents another central area where money creation affects daily life. The price of homes often reflects the availability of credit, as mortgages rely on borrowing that expands the money supply. When interest rates are low and credit is plentiful, more people can afford to buy homes, increasing demand and raising prices. Homeownership becomes a symbol of stability, a place where families grow and memories form. People experience pride and comfort, knowing they have a space of their own. Yet, rising prices can also create challenges. Younger generations may struggle to enter the housing market, feeling as though a key milestone remains out of reach. Cities may experience widening divides between owners and renters. These differences influence families, relationships, and long-term planning in ways that extend far beyond financial metrics. Education, too, is influenced by credit. Many people pursue higher studies through loans that draw upon the power of money creation. These loans create opportunities that can transform lives. Education opens new paths, expands skills, and increases earning potential. Yet the weight of debt can shape emotional experiences long after graduation. Some feel empowered by their education, viewing their debt as a meaningful investment. Others experience stress, adjusting their career choices or spending habits to manage obligations. In both cases, the presence of credit becomes interwoven with self-perception and life direction, influencing identity in subtle ways. Family life is shaped by financial conditions in countless small moments. Decisions about marriage, children, travel, and lifestyle often depend on perceptions of financial security. When credit flows easily and employment feels stable, families may feel encouraged to take steps toward growth. They might move to a larger home, welcome a child, or pursue long-term projects. These milestones create emotional richness, moments of joy and connection that define the course of a lifetime. When financial conditions tighten, families may postpone decisions, adjust routines, or approach the future with caution. These emotional shifts ripple through relationships, shaping communication, expectations, and daily interactions. Personal identity is also influenced by financial experience. People often define themselves through their work, achievements, and responsibilities. Money becomes intertwined with self-esteem, creating a sense of capability when finances are stable, and a sense of pressure when they are not. A person who manages deadlines, pays bills, and supports loved ones may feel grounded and confident. When financial stress emerges, that confidence may waver. These emotional dynamics influence how individuals view themselves in relation to others, how they set goals, and how they interpret the meaning of their efforts. The experience of risk and safety also plays a prominent role. Some individuals embrace risk, pursuing investments, entrepreneurship, or ambitious projects. Their willingness to take chances is often supported by access to credit, savings, or a safety net. Others feel uneasy about risk, preferring stability over opportunity. Their caution may arise from past experiences, limited resources, or the emotional weight of financial uncertainty. These differences shape career choices, lifestyle preferences, and long-term planning. They also influence how people interact with financial tools, whether they approach credit as a gateway to growth or a source of vulnerability. The emotional weight of debt deserves particular attention. Debt can be a bridge, enabling people to achieve goals that would otherwise take decades to reach. Yet, debt can also feel like a burden, creating a sense of obligation that lingers in the background of daily life. A person may wake each morning with the quiet knowledge that repayment awaits. This awareness shapes decisions about work, leisure, and personal development. It may foster discipline, focus, and responsibility. It may also create pressure, tension, or fatigue. Debt becomes not only a financial condition, but an emotional companion. Savings, in contrast, provide a sense of security. Even small amounts give people confidence that they can handle unexpected situations. Savings offer peace of mind, a buffer against uncertainty, and reassurance during difficult times. This emotional comfort influences how people approach risk and how they interpret their place within the financial system. Individuals with substantial savings may feel more autonomous, capable of making bold decisions or weathering setbacks. Those without savings may feel vulnerable, exposed to disruptions, and hesitant to pursue opportunities. The workplace environment reflects broader credit conditions as well. During expansion, companies invest in innovation, technology, and workforce development. Employees may receive training, support, and opportunities for advancement. Workplaces feel dynamic and forward-moving. During contraction, focus shifts to efficiency, cost management, and preservation. Employees may experience fewer opportunities for advancement or feel pressure to demonstrate value. These changes influence workplace culture, morale, and job satisfaction, shaping how people perceive their roles and futures. Community life is shaped by financial conditions just as deeply. When credit supports growth, communities may build new businesses, public spaces, and cultural institutions. Streets become livelier, infrastructure improves, and local pride grows. During downturns, communities may experience closures, empty storefronts, or reduced public services. These shifts influence social cohesion, shaping whether neighborhoods feel vibrant or constrained. Local relationships absorb the emotional effects of financial conditions, influencing how people connect with one another and how they interpret shared experiences. Even leisure and daily routines are influenced by financial stability. Choices about dining, travel, hobbies, and relaxation often reflect underlying economic conditions. During prosperous times, people feel freer to explore new interests or invest in personal growth. During periods of caution, they may simplify routines, focus on essentials, or postpone discretionary activities. These changes influence emotional well-being, shaping how people experience time, space, and social life. Technology has intensified these dynamics. Digital platforms provide constant visibility into personal finances, allowing people to track spending, monitor investments, or review accounts with unprecedented detail. This visibility can create a sense of control, but also a heightened awareness of financial pressure. Statistications, charts, and automated updates become part of daily life, shaping emotional responses to income, expenses, and savings. People interpret financial information not as abstract figures, but as reflections of personal progress, responsibility, and stability. Global connectivity introduces an additional layer of influence. People see economic events unfolding across the world in real time. They observe fluctuations in markets, changes in currencies, and international developments that once felt distant. This awareness can create a sense of interconnectedness, but also a sense of exposure. The global financial system becomes a backdrop to personal decisions, reminding individuals that stability depends on forces that extend far beyond their immediate environment. Despite these influences, daily life remains grounded in moments of meaning, connection, and personal purpose. People build relationships, pursue passions, and find fulfillment in ways that transcend financial conditions. Money shapes circumstances, but individuals shape interpretations. They navigate uncertainty with resilience, creativity, and a desire for well-being that extends beyond the boundaries of the financial system. As this part of the narrative comes to rest, the world sees how deeply money creation influences intimate human experiences. Work, home, relationships, identity, and emotion all interact with the flow of credit that underlies modern life. The next part explores how societies respond collectively to these influences, how institutions, communities, and individuals adapt, innovate, and prepare for a future shaped by continuous financial evolution. The future of money creation unfolds not as a fixed destination, but as a continuing movement, evolution, shaped by human decisions, institutional adaptation, technological innovation, and the quiet rhythms of trust that have guided finance for centuries. Societies do not merely react to financial conditions, They shape them through collective choices, cultural responses, and structural reforms. As people navigate the opportunities and challenges created by modern finance, they develop new expectations, new forms of cooperation, and new visions of stability and opportunity. The final movement of this narrative explores how societies adapt to the ever-changing landscape of money, preparing for a future that is both uncertain and full of possibility. Every generation inherits a financial system shaped by those who came before. They observe its strengths and weaknesses, its fairness and flaws, and they respond with reforms that reflect new values. These reforms may emerge quietly through incremental adjustments to regulation or policy, or dramatically through sweeping changes prompted by crises or large shifts in global conditions. In both cases, societies move forward not by erasing the past, but by layering new structures atop old foundations. The core principles of trust, cooperation, and credit endure even as the forms they take evolve. One of the most significant areas of adaptation lies in financial regulation. As new technologies, products, and institutions emerge, governments and central banks adjust oversight to ensure that innovation aligns with safety and fairness. They create standards for digital payments, establish rules for lending platforms, and strengthen cybersecurity requirements. These regulations aim to preserve stability while encouraging responsible growth. Effective regulation acknowledges that money creation thrives when freedom and safety coexist, when individuals and businesses can borrow, invest, and innovate within a system that protects them from unnecessary risk. The future of regulation also involves greater cooperation across borders. Because money moves globally, no single country can manage its financial stability in isolation. International coordination allows nations to monitor global trends, respond to shared risks, and support one another during crises. Agreements between central banks, lending arrangements between regions, and collaborative regulatory frameworks create a global safety net. This cooperation reflects the understanding that in an interconnected world, stability is a shared responsibility, and resilience depends on trust that extends beyond national boundaries. Innovation plays a central role in shaping the future of money creation. Advances in technology continue to introduce new tools that enhance efficiency, transparency, and access. Digital platforms evolve to support faster payments, more flexible lending, and broader financial inclusion. Artificial intelligence expands the ability of institutions to analyze trends, detect risks, and understand consumer needs. Cryptographic systems introduce new ways to verify transactions and maintain secure records. These innovations reduce friction, lower costs, and expand the potential for economic participation. They create opportunities for individuals and businesses that once faced barriers to financial services. Yet innovation must be approached thoughtfully. Technologies that increase speed or automation can also amplify instability if not integrated carefully. As societies adopt new tools, they must understand their implications, educate users, maintain safeguards that protect against misuse. Innovation should enhance human well-being, not overwhelm it. The future of finance will depend on the ability of institutions and individuals to balance its excitement for new possibilities with a clear understanding of responsibility. Financial inclusion stands as one of the most promising areas of future development. Around the world, millions of people still lack access to banks, credit, or secure means of storing value. Digital technologies offer a pathway toward greater inclusion, but only if implemented with sensitivity to local conditions. Mobile banking, digital wallets, and microcredit platforms have already transformed financial life in many regions. As societies continue this progress, they must ensure that inclusion is not limited to access, but extends to understanding. Education, trust, and cultural relevance must guide the expansion of financial participation. Inclusion is not merely about providing tools. It is about empowering individuals to use those tools confidently and effectively. Another significant area of adaptation is environmental and social sustainability. The financial system increasingly plays a role in addressing global challenges such as climate change, resource management, and social inequality. Banks and investors incorporate environmental considerations into lending decisions. Governments incentivize sustainable development. Global institutions encourage collaboration on issues that extend beyond traditional economic boundaries. Money creation becomes intertwined with long-term well-being, reflecting a broader vision of stability, one that includes ecological balance, social equity, and intergenerational responsibility. In addition to structural changes, societies adapt psychologically as people experience economic cycles, technological shifts, and global interdependence. Their understanding of security and opportunity evolves. Younger generations grow up in a world where money is digital, markets are global, and financial information moves instantly. Their expectations differ from those of earlier generations who relied more heavily on physical cash, local institutions, and slower rhythms of financial life. These evolving expectations influence how societies design education, structure, work, and approach the future. Financial literacy becomes essential not only for personal well-being, but for the collective capacity to navigate an ever-changing system. Communities also play a role in shaping the future of finance. Local networks, families, organizations, cooperatives, and civic institutions create frameworks of support that operate alongside formal financial systems. They provide mentorship, share resources, and reinforce values of cooperation and resilience. These community-based structures complement the broader financial system, grounding it in human relationships and cultural traditions. They remind individuals that while money influences life, it does not define it entirely. Community strength offers stability that money alone cannot provide. The growing integration of technology, finance, and daily life also raises philosophical questions. What does it mean to trust institutions in an era where algorithms make decisions? How should societies balance personal privacy with financial transparency? What responsibilities do institutions have when their actions influence billions across the world? These questions reflect the human dimension of finance. They remind societies that the future of money creation must be guided not only by efficiency, but by ethics, empathy, and shared purpose. As global systems evolve, crises will inevitably occur. Economic downturns, technological disruptions, or geopolitical tensions will test the resilience of institutions and communities. Yet, history shows that each crisis becomes an opportunity for learning and renewal. Societies emerge with stronger frameworks, clearer policies, and deeper cooperation. The ability to adapt, reflect, and rebuild becomes one of the defining strengths of the modern financial world. Trust, once shaken, can be restored. Systems, once strained, can be improved. The flow of credit, once interrupted, can resume with new patterns of prudence and hope. The future may also bring entirely new forms of money. Digital currencies issued by central banks may become widespread, offering secure and programmable tools for everyday transactions. Decentralized networks may introduce new methods of value exchange that operate independently of traditional institutions. Biometric identity systems may streamline financial participation while enhancing security. The boundaries between local and global finance may continue to blur, creating a world where value moves seamlessly, guided by networks rather than geography. Each development will reshape expectations and require thoughtful adaptation. Despite the evolution of technology and institutions, the essence of money creation remains rooted in human behavior. People borrow because they believe in their future. Banks lend because they trust in the ability of borrowers to fulfill their promises. Central banks guide the system because they understand the power of confidence, communication, and subtle influence. The system of money creation is not merely a machine. It is a living network sustained by hope, effort, and shared understanding. Its future depends on how societies nurture these qualities. As the final part of the narrative comes to rest, a quiet realization emerges. Money, for all its power and complexity, remains a tool, one shaped by trust, guided by cooperation, and directed toward human goals. The system of money creation reflects the values, decisions, and dreams of the societies that built it. Its future will be shaped not by inevitability, but by intention. Each generation will contribute to its evolution, balancing innovation with stability, fairness with freedom, and opportunity with responsibility. The story of money creation does not end. It continues in every loan taken, every payment made, every policy written, and every decision that strengthens or tests the trust that holds the system together. Continues in the quiet choices individuals make each day, guided by hope for a future where stability, inclusion, and opportunity expand gently across time, shaped always by the invisible yet enduring power of trust.